Okay, so welcome everybody to this online workshop on housing, which we organize in the context of our partnership with SCORE, which is the biggest French reinsurance company. And thanks to their generosity, we have this joint program dealing with the issue of macroeconomic risk. And of course, this has many aspects. We have talked a lot about inflation risk, all sorts of things. But as a reinsurance company, SCORE is very concerned, in particular, with a class of risk that affects asset returns, of course. And this is why we thought that it would be a good idea to organize a workshop on an important class of assets, which is housing. So this is, if you want, the genesis or story of this workshop. And so we have 4 presentations of 45 minutes each. I guess what do we do? You have, well, of course, people are free to interrupt, but as a guideline, you can talk for, say, 35 minutes and leave some 10 minutes, 15 minutes for discussion. Does it make sense to everybody?
Yeah, very good plan, but feel free to ask questions and interrupt whenever you want. You hear me well, no?
Yes, quite well, as far as I'm concerned.
Yeah, thank you.
So Pedro, the floor is yours, and we have until 3:15.
Thank you very much. So first of all, congratulations to all the French in the room, no, after the victory yesterday and the match you have on Sunday, no, for the final. Okay, and
thank you.
Thank you very much to Gilles, to Axel, to everybody who invited and organizes this event. Is very nice, and I see also very familiar faces from the US. So thank you very much. So when Axel contacted me, she asked me for a paper we just published in the Review of Economic Studies. We changed the paper, and now we're giving a new project. So it's kind of very new. It's the first time I'm presenting this. So we think the paper has interesting insights, but some things are really work in progress. And we're going to value a lot your feedback. We even changed the title because we want to focus on this paper on, there are two things that happen in housing markets after financial crisis that I think are kind of very, very important and shocking. And they are connected. No, the first one is the drop in homeownership. There was a collapse in homeownership, and I'm going to show you today is not a US fact, it's a worldwide event. And you can see here that if you see homeownership after financial crisis is going to collapse. Okay, and at the same time we see a big increase in the presence of real estate investors. And by investors I mean people who are buying housing for investment purposes. Okay, not people who live in the house and they consider this to be their ownership, their home plus an investment. Okay, and there is a
so these two things add up 100%.
What do you mean? Can you say again the question? Sorry, to understand you.
Yes, my question is, what this is the share of what?
Okay, good. So let me explain you. Sure, very good question. Okay, so homeownership is the share of the households who report to own the house in which they live, and the investor share.
Total households.
Yes. Okay. So when you have 100%, everybody is a homeowner. Okay. An investor share here, what we got is the amount of transactions in the US, and among the transactions in the US, we are able to identify who is an investor because has more than, I think we put the cutoff in 2-3 houses. Okay, so if you have multiple properties, we call you an investor, and you see that's the share of the total transactions that are attributed to investors. Okay. So if you see after the financial crisis, both things are happening. Okay, and there is a recent paper by a French who is there at INSEAD, Pierre Mabille, who published in the Review of Financial Studies a paper studying especially the drop in homeownership. And he has this kind of pictures in which basically, if you see this picture, and the focus of his paper is what happens to the young, okay? What happens to the people who are kind of below or 44 years old? And this picture that is, we replicated his paper, you see that the young, basically, homeownership collapse. So you see the number of households who own houses in the US collapsed by 20%, okay? It has recovered a bit recently, but you see that is not at all even similar to what this was before the financial crisis. And Pierre Mabille, he attributes in his paper this basically to tight credit and low income for the young. And when we started this project, we want to do kind of complementary. We thought, well, there are two things missing in this literature, we thought. One is the role of the elder. And we want to explore what's happening to the elder. And I'm going to show you that there are many things happening to the elder, especially the elder are becoming investors. Okay. And the second, we wanted to understand if you put investors in a model of housing, how this matters for the economy and for housing markets. So our motivation was basically, we read the paper, we liked this paper of Mabille, we thought there is room to improve in these other dimensions, and we thought that that this is especially interesting because when you see the investors in the US, the real estate investors, I have an empirical paper with Carlos Garriga, Atena Sodero, that I think they are here, and what we see is that when you think on real estate investors, you have to think on two types of investors. You have on one side the very big ones, like if you want to think on the BlackRocks of the world, the REITs, in France we call it Société Foncière, you have the big ones, okay, the very rich. But you have also the very medium and small people who are usually kind of wealthy individuals. In the US, for example, I gave talks in universities, and finance professors in the US qualify well for this. In France, maybe are people in the industry that basically they have 2-3 apartments in Paris, and this gives you a very good revenue. So you see, these are people who are not mega rich, okay? But this, especially this kind of people that are in the kind of a small, medium part of the distribution of holdings, they increase a lot recently. And we think that this is basically a manifestation of two things, and the literature has studied these too. So we have first a paper by Wenli, I see there, Wenli, in which I think she studied especially what I would call the first phase, no? Is that the crisis generated an opportunity to buy foreclosure properties, housing was cheap, and I think this attracted investors everywhere. And I see this very complementary to the second explanation that that was my motivation when I started doing empirical work with Carlos Garriga and Athena Sodero, in which we thought the complementary explanation is basically a portfolio rebalance channel. If you think what happened in most countries, certificates of deposits, bank accounts, deposit rates collapse, especially quantitative easing is what this has produced. This has created a spread to rental yields. This became even larger during the COVID. So if you see the data, for example, this is the US. So here in this graph in the US, we are going to compare the 5-year certificate of deposit. This is the dashed line. This is the return from the certificate of deposit. A certificate of deposits in Europe is like a savings account that you make interest. And the solid blue line is the rental yield from renting housing. This comes from a paper by Demers and Eisfeld, and these papers, they try to control for many things, for the renovations, for the operation costs, for many things. And you see that basically, especially recently, there is a significant gap towards the historical norm. So then we thought
thiếu mất một cái này.
QE means quantitative easing. Somebody was asking what is QE, quantitative easing. Basically, what I'm thinking is all the policies the central banks have been trying to do to lower the federal funds rate, the ECB, or even asset purchases. Another way to do this is see the same in Spain. This is the Spanish version of the same thing. So here we have in blue the 10-year bond yield in Spain. In kind of red, I don't know the color, kind of red, okay, this is the gross return on housing, on rental housing in Spain. And if you see, we see that that basically after the financial crisis, we see this has increased. During the COVID, this gap increased even more. okay, and the gap is kind of 4 percentage points, and this is an average, okay, but this is saying, look, from a search for income perspective, investing in housing and you are looking for generating income is an asset that gain in attraction, okay?
But
So
what these pictures tell me is that there was a housing bubble. So the yield on housing was quite low. No, I mean, 10-year bond yield, this is what safe asset, no?
okay,
So
so
then house prices fell, and so quite naturally the bubble sort of burst or disinflated. As the bubble shrunk, the yield on housing went up, which I think explains the divergence between housing yields and bond yields. Because
okay.
what's surprising is that the gap increases is one thing, but they actually, I mean, at least for a while, they go in opposite direction.
Yeah, so I think, Gilles, you are totally right here. There are different things. The first is why this happens. The second, what are the consequences of this? In this paper, we're going to focus especially on the consequence of this, okay? And the why it happens, there are multiple factors. On one way, there are the house prices. In the other, the central bank's policies that are affecting safe assets also are fathers of this, okay? But I think your question is very good, and maybe when we do the analysis with the model, we can go back to it. But I want to separate the two things. Why this happened are the consequence of this. And what we believe is understudied are the consequence of this, is what we try to study in this paper. So in this paper, we're going to do two things. First, we want to show you data on the international dimension of these facts, because we think that that was something we wanted to see how much of this is a US fact or is a global effect. And this is very important to understand the why, because the US is very special on some things and in other things are not special. So if the facts are common across Europe and the US, this is showing that there has to be the global forces appearing everywhere. And then we wanted to write what we believe is the kind of first really macro model of investors in housing markets. And what do I mean by investors? The novelty here of the paper is going to be to have investment housing like an asset class. So it's going to be in the model. I'm going to show you the equations later, but we're going to have a housing stock in which you buy for ownership, for living there, and a housing stock that you live for investment purposes, okay? And when we went through the macro literature on housing, this was missing. And even in finance, if you think most finance papers, they think on asset classes, they think on bonds, stocks, and sometimes they call it alternative investments, but housing has not been considered like an asset class. But I think this is really what is novel. It's like, if you speak more and more to the BlackRocks of the world, they tell you, look, housing is more and more an asset class. So we put a model in which housing is going to appear like an asset class, and we study the implications. We are not going to study the question of Gilles so much of why this happens. Okay, so we're focused on the implications. And then for those of you who may have to leave or whatever, I want to give you like, what are the takeaways of the research so far? So the first thing we find is that there is a lot of action for the elder. Okay, and that's why I say we complement Mabil, that he focused on the young. I want to say many things are happening for the elder. And what we notice is that these elder, and especially the wealthy elders, are becoming housing investors kind of in Spain, in the US. We think that it's kind of an everywhere phenomenon, this idea of an increase on real estate investor. And when we think on the consequence of this, we want to claim that this is important because the presence of investors is going to change the elasticity with which the housing stock gets converted from ownership to rental. And this implies that the impact of macro shocks is going to change. Basically, prices are going to fluctuate less, but quantities in terms of home ownership are going to fluctuate more. And that's one of these consequences we want to show you today in the paper. It's kind of a theory. It's a theory result because we are going to show this in the paper, and we need to prove this more. In the empirical paper I have with Garriga and Pedro, we start showing this, investors cushion the changes in house prices. And then we wanted to use the model like a simulator for policies, because now in many countries, there are policymakers that don't like investors in housing markets. And there have been two kinds of policies through rent control and policies through taxation. And we wanted to study the effect of these policies. And we are finding that these policies, they have different effects on different types of investors. And given the heterogeneity of investors, we thought this was important to understand, because we are seeing that these policies can be very bad for the middle class, senior or elder people, okay? These guys are going to react, they have large effects, and these guys are also voters. So it's not obvious what's the political economy of this policy. So this is basically what I'm going to do in the paper. Now I'm going to show you data. Then I want to show you a macro model with housing like an investment class. I want to show you the effect of putting investors when you give macro shocks. I'm going to replicate Mabel with investors, basically. Okay. And then I want to tell you what happens when you do these policies to prevent investors from coming and how this affects different types of investors. That's kind of, that's the plan for the remaining of the talk. So let me show you.
Can I ask a question maybe? So on the data, so I think in the US, like across different states, there are different regulations on how you can default on mortgage for your non-first house. Is this something that you could exploit maybe empirically to like show some of differences across states and maybe different propagation mechanisms?
Yeah, I think that's very good comment. Yes. So look, this is something we can copy here in the list. That's why I tell you that I appreciate all the comments. I'm not going to have an answer for most of them because it's very novel, but yes, that's something to explore. A problem that we discovered in the US, and that's why I was very interested in the non-US experience, is that when I was working in the US, I noticed that in the US, it's very easy to create legal forms. Like in the US, they call this LLP, trust, LLCs. So basically, these are legal forms to protect the individuals or to do risk limited liability. For example, my co-author Pedro, she was renting in Miami, and she told me that the owner of the property is an individual, but he's not renting through an individual, he's renting through an LLP. Okay, and why this is a problem? The problem is that it's very hard to see the holdings of these societies, because if you go to the Survey of Consumer Finances, the owner of the housing stock is basically the society. Okay, so we don't know yet. Maybe Wenli, who works at the Fed, she will know all these things better. But you see, it's not obvious to me how you ask. I tell you, this guy in Miami, and he has shares in this limited liability company, and then he's not going to clear housing. So when we are going to show you some data on the Survey of Consumer Finances of the US, but then we move to Spain, because I'm Spanish, I know Spain, and in Spain, these things don't happen. Okay, in Spain and in France, I think it's the same. It's not so easy to create all these societies to buy 2 houses in Paris. Okay, so when you look in the US, this is the top quartile of the income distribution. You see that for investment properties by age, you can see this general trend that the elder people have larger holdings of investment properties in housing. Remember, these are investment properties. If I show you the same for the housing which they live, you also see that there are some difference between age groups, but they are very small. See this. This is the value of the main residency for different age groups in the Survey of Consumer Finances. So if you can see the red line with the other lines, they are much close. So this is telling you they all behave very similarly. But if you see the previous one, the value of the investment property, you see quite a significant change there. So what is this telling you? This is telling you that especially the elder people in the US have been accumulating, okay, more properties for investment purposes relative to the younger. So this is first evidence that the elder are doing something, okay? Then we went to Europe, okay? And in Europe, we went to Spain first, okay? And in Spain, what do we see? We see the same thing that Mabel for young households. So homeownership is the left part of the distribution, is going to collapse. You see the big drop in homeownership. These are, each one of these year is so the Spain copied the Survey of Consumer Finances from the US, and they do this every 4 years, okay? And you can see here the dynamics of homeownership. You can see
homeownership collapsed
for the young.
Collapses.
Yeah, for
the
the
stock
young.
of housing presumably does not collapse, right?
Exactly. And this is basically
so either people are living in bigger homes, which I doubt, or the residual is investor ownership that goes up as a share of total housing, right?
You totally got it right. Give me a moment and I go there, okay? So, because I want to follow the order. So first, this FAD is similar in the UK, okay? And we analyze several European countries because European countries have a system to share the survey of consumer finances. And basically, in nearly all European countries, we see the same thing except for France. You see, France is very interesting because if you see France, okay, the French system is an exception, like in many other things, but on this is an exception. Homeownership didn't collapse, okay? So in the agenda for me, one day is to understand better what's going on in France that didn't collapse housing that way. Maybe it's because all this system of subsidies, support for the young. You see, I was an Erasmus student in France. I spent several years in France. And my feeling was that in France, there are many ways in which the government intervene, but France is really the exception. If you take France out of the European countries, in all the others, homeownership collapse. And then I go to the question of, I think it was Gilles. What's going on here? Basically, in Spain, this is again back to Spain. If you see the share of households,
for France, I don't know if you have looked just at the levels, because on the levels for the young quite low compared to other countries. I mean, maybe there is not so much room for collapsing.
Okay, that's a very good comment, right? If you are near to zero, you don't have much to fall, right? Very good. Yeah. That's why I wanted to put
the graph for Spain again. Sorry.
Say it again.
Can you show us the graph for Spain again?
Yeah, this is Spain.
The levels.
Okay, so you see Spain.
So if I look at 1730, these are much higher rates than in France.
Yeah, I agree with you.
France, we are at 20. So
you see, I agree. But if you see that even for the people who, okay, in the 40s, that the levels are closer to 60, nothing changed. You see, when I show you this picture, nothing changed in homeownership in France. But you see that things change in Spain. And if I go to the US, that is this picture, something changed, right? You see even a drop there for the kind of above 45. So it's very interesting at some moment to look at what is the French public intervention in housing doing to homeownership. I think that's
again, it could be that all these people in Spain and the US participated in a bubble and they are no longer owners because there is no longer a bubble. I mean, some. Whereas in France, there was not so much of a bubble. Right?
I agree. It could be. You see, at this moment, you see, we just want to do this kind of thing. Let's put the facts on the table and then we talk. Okay, but you see, that's the fact. But then going to your question, because really the fact that motivates the paper is the next one, is the one I'm going to show you now. So now I'm going to show you now in Spain, the households that declare to have more than one property. And if you see this is increasing, okay? And this, I pick here two surveys, 2002 and 2007, but if you want 17, if you want to see all the surveys are here. So if you see all these surveys in which you can see the dynamics, you see we have 2005, 2008, 2011, 2014, and 2017. It seems to be a pattern in which the households that are elder, they accumulate more than one property. So going to your previous question, Gilles, what's going on? Well, it seems that the young are not buying and these properties are being bought by the elder. And this generates something that we haven't yet looked at the data and think about this, but these elder maybe are the parents of or the family members of the other people, right? So this is generating some kind of dynamics, okay, inside household formation. But the fact is that this seems to be going towards the elder, okay? And if you see, for example, the number of properties, this is very interesting because Spain is a touristic location, right? I think many of you maybe have been come to Spain, there are very beautiful beaches, food is good, all these things. So many people think that this is all basically having two properties, one in Madrid and the other in the beach. But it's not that, because if you see the average number of properties, okay, in 2017, you see that for many people is 2.5. So to have an average of 2.5, it means that many people have 3, 4, 5. Okay, so this cannot be people who are just buying a house in the beach or in the mountains, right? These are really investors that they have multiple properties. Okay, so that's kind of what we are trying to pass from this. Okay, like in the same that in the US we have evidence of investors, in Spain here we have evidence of investors. We didn't do the analysis for Spain, for France. Okay, that's something in the to-do list, but that's how we interpret the data so far, okay? Investors, you see the interpretation of the data so far is our investors are increasing, age has something to say with investors. This is something about the elder, okay? And this is a global phenomenon, okay? And then we wanted to say, well, what are the implications of this? How do we think on this for theory? So we went and we wrote a macro model in which the novelty is going to be that now the households are going to buy houses to live in the households, but also to invest. Okay, if you invest in a property, you are going to have a rental yield. So it's going to be very similar to a bond with the difference of liquidity. Okay, but this is going to be a portfolio problem between bonds and real estate. We are going to ignore stocks. The reason we do this is because if you ask many people about housing, they think on this like a very safe asset. They usually think on housing like a conservative investment. People don't think on this like the investing in the Nasdaq. Okay, or cryptocurrencies. Okay, we are going to abstract from inflation, even if we believe that inflation is going to matter a lot on real estate. But so far we started exogenous risk-free rate, abstract from inflation. Okay, the model is going to be an overlapping generations model, so it's going to mean that people are going to live for G periods. We are going to have several cohorts. People work for the first J years, then they retire, and households here they have income risk, and they are going to be heterogeneous on these dimensions. So there is going to be heterogeneity among them. So for people who are familiar with macro models of housing, we try to be very standard. So the preferences are very standard. You enjoy consumption, you enjoy housing services. When you die, you give a bequest. Okay, the standard thing in housing markets is to say that you have to choose between renting and ownership. If you own the house in which you live, you get an extra happiness, and this is the reason people love to become homeowners. This can be motivated many ways. Okay, there are many motivations in the literature, but we just put this kind of premium to put people to want to be homeowners. We went for CRR, constant relative risk aversion utility, that are very standard. So basically housing services and consumption are complements somehow. Okay, services, either you rent, either you own. If you own, you enjoy the services more. Okay, so that's very, very standard. We put a standard reason for bequest. For in the models of heterogeneous agents, it was very standard. We give an idiosyncratic shocks to labor income. When you retire, you get a share of your previous income. So all that is very, very standard. And the novelty comes in the housing market. Okay, so in the housing markets, in the model, we're going to have endogenous house prices and rental prices. We're going to make housing illiquid, and we think that's important because basically bonds you can sell and buy without transaction cost, but housing you have a transaction cost. There is also depreciation, and we introduce mortgage markets. The mortgage markets, we are going to assume that the mortgage rate is exogenous. So in that part, the model is going to be a simplification. We are going to assume constant amortization mortgages. Okay, so that's kind of a standard. The evolution of the mortgage debt is also kind of a standard. And we're going to introduce two constraints to kind of play for what people call, and here the literature is creative. We call it tightening of financial constraints, financial innovation, LTV, payment to income. See, the literature agrees and disagrees a little bit. Okay, these are kind of the financial crisis shocks. What is clear is access to credit become more difficult. That's one kind of the shocks. But the novelty is that the paper has households in 7 situations. You can be a household is going to buy owner-occupied housing. You can be a household that is going to do only investment housing. You can do a household doing both things. You can do a housing doing no change. You can do a housing doing refinancing. You can be a rental. You can be a defaulter. So I'm not going to have time to present everything. I want to present the novelty. The novelty is here. If you see the budget constraints, okay, the households are going to have 2 H. It's going to have H with a prime, that's the housing ownership for next period. And then you are going to have this extra term that appears here in the budget constraints, that this is the investment housing. And if you see what the investment housing does, is that it gives you, if you buy it, it gives you like an extra income, the price of housing, that this is PS, this is the price of a housing service. That this PS is the rental housing. So I think the novelty of the paper, so the model is standard in every dimension, except on the presence of these H tildes that generate a new portfolio model, and you're going to have these households that can decide to be investors and invest here. Okay, that's basically the novelty of the model. Okay,
What difference does it make if I call H tilde, whatever, you know, omega, and I don't call it housing? I mean,
okay, so then that's a very good question. You're asking, what is housing as an asset class? So housing for us is an asset that is illiquid, because if you see here, okay, there are transaction costs associated with selling it. So these TAUs are transaction costs. So this is an asset that is illiquid, is an asset that depreciates, that's this delta, and is an asset that gives you income from rents. So these are these three things. If you think on bonds, the bonds are the Bs. So the bonds are not illiquid and they don't depreciate, but they give some return from the bonds. So you see, so then bonds are not illiquid, they don't depreciate. That's the two difference with housing. If you think on stocks, the same. If you think on other assets like maybe wine, art, other properties, I think those properties are going to be liquid also, but maybe they don't depreciate. But then when
what's important are the characteristics of this asset as an asset.
Exactly.
And the fact that I may have something which is both an investment and a place where I live does not play a role in the model.
Okay, that's a very good point. Okay, so you see the fact that
the question.
So you see what we are not. Okay, I don't. Can you say the last sentence again, just to see I understood in the same way?
I'm saying H tilde is an asset that has such and such characteristics as you just explained, right?
Exactly.
So depreciation, illiquidity, etc.
Exactly. These are the three things.
But in the model, there is no action coming from the fact that it's something which is both an asset and a place where I could live.
Okay, very good, very good.
The two are separate in the analysis.
So that's why we split the two. You see I have two H here. You see I have two H. Okay, right. The H without the tilde, this is where you live.
Yeah, I know.
And this is where you invest. And that's why we are splitting the difference between the two. Okay?
Right. But because for instead example, of H tilde, I buy a derivative crafted by a corporation in Japan that has exactly the same properties as H tilde, but is not housing, nothing is changed.
I agree with you. Okay, but the problem is that it's going to be very hard to you to find those kind of illiquid.
I want to have an idea of where your results come from and what is
exactly
core mechanism.
This is Gilles. This is a little bit the agenda we are having now. You see, I'm trying to apply this idea of write one paper and publish it several times, right? So I'm trying to think now on kind of the portfolio problems with illiquid.
It's called the Gene Grossman strategy.
Yeah, exactly. So portfolio problems with illiquid assets. And if you know in finance all the literature on portfolio, usually liquidity is not a super important thing. But for housing, I think it's first order. I think what makes housing be a special asset is that usually it's very illiquid. Even if now there are all these innovations to try to make it more liquid, but it's usually lumpy, it's in big shares. That's why also we discretize housing. If you see housing here, we make housing to have a minimum house. You cannot buy in Paris 1 square meter. It doesn't exist. You need to buy minimum 1 bedroom or 1 studio. You see? So this is also what makes housing kind of special. That it comes by size, by kind of minimum size, that is illiquid, it generates some return. Even we are going to put at some moment this kind of management things. It's not so easy to manage housing if you are far away. Okay, so this is what I think makes housing special. But we haven't explored all the dimensions yet. You see, I tell you the ones we have. Okay.
Can I ask more question on the same topic actually? So the transaction cost is going to be the same for H and H tilde.
Yeah, I assume we simplify. We are trying to make the model very clean. You see?
No, because I mean, then it means that all the difference between H and H tilde is going to be captured by the curvature in your U.
It's going to be.
Well, in fact, it's probably less costly to. I mean, transaction cost is probably lower for what's not your primary house, right?
So you got something very right. If I buy for myself, the key is utility, because I'm not pricing at the same level than the price of this. Okay, in fact, this is something very interesting. We could compare the marginal value you attach to homeownership housing versus the rental market. And we're going to see that the guys who are in the margin are the guys who are the marginal renter. Right. Okay, that's very good. But you remark, we are not introducing heterogeneity in preferences. If we introduce heterogeneity in preference, your channel would be very much more important than it is now. Okay, but you are.
Yeah, but it seems to me that for policy, I mean, for policy changes, it's not so obvious that doing this assumption that the transaction cost is the same is what you should do. I don't know.
Yeah, I see. Well, we think usually if you think on transaction cost on housing, for me, it's usually realtors and taxes, right? Realtors take maybe 5%, and taxes in Spain is kind of 5%. In the US is lower. I don't know. In France, probably is high also. Okay, so you see, usually these two things, I don't think discriminate too much if you are homeowner on the other. That's why we didn't want to go there too much. Okay, and also because for the mechanism I'm going to show you now, we wanted to try to be clean. Okay, that's why we went there. And then the other part of the model, and this is the part in which I think you can see these things, is in the market clearing. So you see here, we have here the housing market and we have the rental market. And there are two kinds of demand in the housing market. We have the homeowners on the left, and we have the investors on the right. You see, this is the demand for investment from the investors. The sum of the two has to be equal to the housing stock. And in this case, we follow Mabil. We let the housing stock to change a little bit. Okay, this is something I disagree with the co-authors, but in this version, we did it. Okay, because we copy Mabil. But see, I thought it was, anyway, we will explore this in future versions, and your income is appreciated. And then we have the rental market, in which you can see that we have on one side the demand for rents on the left, and then we have the supply of rental housing, and the supply of rental housing are the investors. So in this model, what we don't allow is to have the kind of speculators that buys a house, keep it empty, and sells later. You see, by construction, that's not possible. Okay, I think integrating that wouldn't be so difficult, is to create a kind of a search model there. I don't think it's so important that number of people doing that, okay, because you really have to be short term to keep the house empty, okay, but that mechanism is not there, okay, the speculators with the empty houses, okay, and then the exercise we are going to do is that we are going to be giving shocks. So we do two exercises. I'm going to have time to show you only one, okay. So we do what we call the financial crisis exercise. This is the exercise that Mabil is doing, but most of the literature is doing this. There are many papers these days giving shocks to loan to value, pay to income, because it was a big thing with the crisis, and the literature is very large. So we give that exercise, and the exercise we want to do is what happens different because you have investors. That is our novelty. And then we do a second exercise, that is what we call the quantitative easing exercise, because if you study the COVID recession, or I mean the COVID experience, in COVID, we didn't have tight credit constraints. You see, it didn't happen during the COVID. But during the COVID was a period in which central banks were really expanding quantitative easing, and the drop in risk-free rates was even larger. So if you see, for example, the US, federal funds rate moved from being close to 2 to 0, something like that, okay? So in this second exercise, there are not going to be financial shocks, okay? But I'm going to show you today only the first one, because this is a very good way to compare with the literature. And we wanted to be able to compare a model with investors with a model with no investors. So then we did the following trick. We introduced a tax, okay, on the returns from housing. Why we put this tax here? When I make this tax very large, it's not very interesting to be a housing investor, okay? So comparing a model with a tax with a model with no tax is going to be very useful for us to understand what the investors are doing, because this tax controls the amount of investors. That's what we are going to show. And then also it's very useful for later, because for the policy, we are going to play with the tax, okay? So these are the kind of the shocks we are going to show you. We are going to have tightening of the loan to value, okay? Tightening of the payments to income cap. The young are going to suffer income losses, and then our tax, okay, is going to increase during the period of the shocks in one version of the model, and in the other version, we don't touch it, okay? And then we can start comparing models. Okay, so the first thing you see is, like in all the literature that does LTV, financial shocks, all these kind of financial shocks, you see that basically the young households especially, they reduce credit. And these just households reducing credit is going to have the mechanism of Mabil and the literature that these households are not going to become homeowners. So you see the leverage is going to fall, especially for the young. And now comes the novelty. The novelty is that the housing investors are increasing a lot, especially in the model with no tax. If you compare the blue with the red line is the model with the tax. So the investors increase less. Somebody has a question?
Yes, Patrick, Wenli, can you hear me?
Yeah, I hear you.
Yes, I asked earlier. So there's an earlier literature, in the early 2000s about household portfolio.
I couldn't hear you. Can you get close to the microphone to see if the quality is better?
Open my laptop. Can you hear me now?
Very well now.
Okay. So there is an early literature in the 2000s about, household portfolio decisions in the presence of, residential housing, which, share many of the similar features here, except investors. And I guess one of the important dimensions in your model is really these, the share, like the portfolio, the data, right, of the ones who invest in, in this housing additionally, in addition to their own residency. Are you gonna show us anything about their bond holdings and stuff?
Okay, so I'm going to show you what I have. If you want, I show you what I have, and then you can tell me what is for next time. Thank you for pointing that literature. You have what, the green wall paper, this kind of papers, the
No,
family.
it's more of the finance paper, Joao Gomez, and then my co-author Rial, and yeah. It's like 2003.
I will follow up with that. I need to check that literature, okay? So I wanted to be cautious. If anybody got offended by a comment because I did say something incomplete, just tell me. I say it to the best of my knowledge, okay? Good. So these are here the housing investors that you can see increase. And then comes what I think is the first result, okay? So when we try to see who are the households that react the most, like in the data in Spain, are kind of the people who are in the 50s. Okay, so if you see the people in the 40s, 50s are the guys who decide to go to the portfolio problem, like Wenli is saying, and they try to reduce bond holdings to go into housing. Okay, so these are the middle-aged wealthy are the guys who become the housing investors. Okay.
So in your Spanish data, this would be people with more than one house.
Exactly. So you see the data. In the data here. Okay, the data I have here. You see the guys who really react a lot. You see these guys. Right. This is where you see the reactions. We see this.
So this is what you are explaining.
Exactly. So these are the guys who are really reacting the most. Okay. So that's the model seems to generate something similar. Okay. And what is happening is these are the guys, like Wenli said, they found very attractive. Okay. To see the strong portfolio effect. So if you do this, the previous is by age. If you do this by income, basically the people who save. These are the people who have a portfolio problem. These are the high income people. If you are low income, you don't save. You don't have a portfolio problem. So these are the guys who react a lot to become investors. These are the people who save. Okay. Then what we say is that in the model, there are the two things going on. There is the rental yield and there are the capital gains. And we can see the two effects playing a role. Okay. And the first result is basically in this picture. So if you see what investors do, the housing supply of rentals increase much more in the blue line. Because the housing supply increased much more, and this is a crisis, it means that the economy with investors, rental prices are going to fall much more when there is more supply. So you see the amplification in rental prices. You see that in house prices is the opposite. There is a mitigation of the dynamics because the investors are buying house prices. So this is a cushion of the house prices. And with homeownership, there is amplification again. So you see amplification in rental prices, amplification in homeownership, mitigation in house prices. That's the first kind of result that we see there. Okay, obviously homeownership is going to collapse, especially for the young, like in the data. So that was kind of the first result. Then what we try to do next is to study policies, because if you see the US, for example,
you have 1 minute,
Yeah, so in 1 minute, I'm going to say two things or three things. Okay. The first one, if you see the US now, they have a measure in Congress to try to go, they call it Stop Wall Street Landlords. So it's very clear what it's telling you. They want to tax the big investors. But if you see Europe and the US, they are doing something similar. We have rent control, like for example, see Europe. So Europe is putting rent controls nearly everywhere. Berlin, they even wanted to expropriate the investors. In Spain, now we have policies to put rent controls on investors. Barcelona, even more. So what we did is rent controls and a tax on investors, we think is very similar to the tau that we have in the rental yield. So basically, if you have a return from housing, part of it, we take it from you. Okay, that's the way we are simulating. And then we try to study who are the households who suffer the most. And we found interesting that we see, if you see by age, you see are the seniors, are kind of the people in the 60s and 70s. And these are the seniors, okay, that are not too rich. So if you are too rich, you don't change so much. So you see the income quintiles here. You don't, the high income guys, they participate a lot in housing, and these guys have a lot of money, so they place it everywhere. But what we are seeing, the guys who react the most are, we have in mind kind of middle class, elder people who buy 1 or 2 properties. They are not ultra rich, but these guys are going to suffer a lot with these policies, and they stop participating in the housing market like investors. That's kind of the lesson that we get from this exercise. Okay, so just to be on time, so we have time to talk. Conclusion we got from this is there is action on the elder. We think this is novel in the literature. People have focused too much on, I mean, they have focused on the young. I think we need to focus also on the middle-aged elder people. And we think that adding investors to a macro model alters the volatility of house prices, the volatility of housing rents, amplify the homeownership dynamics. And we think that all these policies to prevent investors, they need to take into account that the investors are heterogeneous. And it seems that the guys will suffer the most can be the middle-class seniors. That's kind of what we talk. I'm on time, more or less. Gilles, we have time for Q&A.
Yes, thank you very much for this very timely presentation. Maybe we allow for one question with each, only marginally in the break later. So,
can I? Oh, I want to follow
yes,
up on
please.
what. Yes, sorry. I want to follow up on what Axel, did I pronounce your name correctly? Said earlier about some of the model features, because one of the concerns, right, in the policy discussion is the investors are in out of the market much faster than than let's say primary homeowners. So I'm imagining if you introduce, let's say, if you let the transaction cost to be lower for these people, and if you introduce some kind of aggregate shocks, particularly in the bond markets. So that could be, so basically these people's only investor housing could be importing, amplifying shocks from other places in the financial market to the housing market, which would, I think, attenuate some of the positive effects you're discussing here, Pedro.
I see. That's a very good question, because what you are saying is basically, if you think here, the kind of investor we have in mind is a household, is a kind of a wealthy household, right? I was giving a similar talk in Notre Dame, and they told me, a guy there told me, yes, this is what I'm doing. I have 3 houses now in the area. Okay, so we are not thinking in the kind of financial institutions that maybe they have some propagation channels, okay, different than this. This is maybe a very good thing to do, Wenli. Maybe I should have the 2 types of investors directly in the model. I should have the institutional investors and the household investors, right?
But even without institutional investor, we hear stories of people like your friends who has 3 houses. If he, I guess he's not going to lose his job. If someone loses, they usually are pretty leveraged up, right? If they lose their jobs. So it's like they can amplify any shocks in the labor market. But I agree with you, it's a quantitative question.
Well, we don't know. That's a quantitative question.
That's a quantitative question, yeah.
Like, for example, yeah, I think in San Luis there is a guy who is a dentist and he has several houses. I don't know how this guy is exposed to the labor income market, right? His supply, his income is very inelastic. People go to the dentist, no? So I don't know. That's a good empirical question. But the problem I see is that in the US, it's very hard to see these things because of these LLPs. If you see the rise of the institutional investors, it's like going to the shadows, right? I think at the central bank, you should push more transparency of these things. Otherwise, how do you see this shadow market?
Yeah, no, I actually was in talk for a little while with the Department of National Security. I think there was all these, yeah, they won't give you anything.
I see, okay.
Yeah.
Okay, thank you very much. And now we move on, and I give the floor to Sonia. Philippe, okay. You wanted to say something, Philippe?
Yes, I just had a question because I am not clear on which mechanism is playing down the situation of the elder, which are less wealthy, that is in the first quintile, because I would have thought the taxation of rent or of the wealth of the home wealth would mainly target the more wealthy people, while are the other more affected than the wealthy people, because it could appear relatively strange. What is the mechanics which is behind it?
Yeah, so the way I think on this is that these elder are more sensitive to a change in the return on income that you get. So when you tax or you do rent controls, because you think on rent control is a tax, basically, okay? Your rents go up by less. Okay?
Yes, but probably the rent control is less redistributive than the taxation, probably.
Yeah, probably, okay? But it's going to be yes. But the guys who are more sensitive to rent control are the not very wealthy households that are very sensitive to that kind of income, because especially you live on retirement income. Okay, and anecdotal evidence is that rent control policies start to be opposed by these kind of savers. Okay, it's kind of a savers mechanism. Okay, you have your saving coming from housing, and you don't like at all that they tax either directly or through rent controls.
Okay.
It makes sense, Philippe, to you?
Yeah, yes, it's clear. It's clear. Okay.
Thank you very much. Now, Sonia, the floor is yours.
Thank you. While I set up, maybe I can give my own comment too. I was thinking about whether the part of the mechanism is parents helping their kids buy a house. So if there's any, I don't know what data you might use to disentangle it, but it would be interesting channel to look at.
I totally agree with you. That question and what happens when the elder pass away, if all this is just a transitory thing until a generation dies, yeah, I don't know. We need to explore more how to get into the data for that kind of generational transfers. I think that's very interesting, yes. Also, this has implications. I mean, Piketty is in your department, no? Piketty that wants to tax wealth transfers, no? Especially like when you pass away, like taxes on real estate inheritance are first order if you think this way, right? Because it's a way to prevent that mechanism or to redistribute, right? So that's something to think about, yeah. Thank you. It's a very good comment, Sonia.
Thanks. All right. I also want to thank the organizers for adding our paper to the program. And it is also a very new project and the first time that we're presenting it. So again, very happy to get feedback. So please feel free to interrupt at any point. So this is a joint work with Brent Ambrose at Penn State and Jim Conklin at University of Georgia and Luis Lopez at University of Illinois at Chicago. I'm also going to be talking about homeownership today, and this is a project about the biggest government program in the US that helps low-income individuals become homeowners. So in France, the counterpart that I have found is prêt conventionné or prêt d'accession sociale. So these are programs that allow low-income individuals to buy homes at really low down payments and at competitive rates. In the US, this program is called Federal Housing Administration. And the programs come with several eligibility criteria, in particular on the borrowers, but also on the properties. And we think it's extremely important for policymakers to understand how these eligibility criteria basically restrict access to housing for FHA borrowers. So the trade-off and the reason why a lot of these criteria are in place are mostly to protect borrowers from risky investments or to protect the program against fraud. And on the flip side, if fewer properties qualify for these programs, then of course the market where FHA borrowers can participate is restricted. And further, if FHA programs are perceived as a hurdle to qualify for it, or if there's a lot of uncertainty, then perhaps sellers also don't want to deal with FHA borrowers, which further restricts purchase opportunities for FHA participants. So in this paper, we're going to focus directly on this second sort of negative channel and think about how sellers might exclude FHA borrowers from the market by not willing to work with them. And because this is a conference about the The cycles, we're also going to see how that force might vary with the housing cycle. So in particular, whether FHA borrowers are more excluded in times where there are lots of buyers in place and sellers have options of who to sell to, versus in situations where there are few buyers out there, and so sellers might be more willing to work with FHA borrowers. So what we have in this project, what we're going to explore, is a direct measure of seller preferences on the financing that they want to work with, the buyer financing that they want to work with. So the data that we're going to use is coming from multiple listing service platforms. So these are platforms where the real estate agents use to advertise listings for sale. There's the survey every year of National Association of Realtors that surveys home buyers and home sellers, and year after year, even with all the technological advancements, we find that the majority of sellers use real estate agents to transact their homes in the US, and as a result, the house that they're selling will end up on this multiple listing service platform. So we have a pretty good snapshot of basically most of the market using this data. And when a seller finds an agent to work with, what they do is they sign a contract with the agent, and the contract specifies the commission, the pricing, all kinds of legal agreements. And here's an example of a contract in Texas. So Texas realtors, so seller receives this document and they check some boxes and they sign it. And one of the questions that they answer is what type of financing is their agent authorized to market the property for? Okay, so in a sense, what kind of financing does the buyer have to be able to bid on the house to buy it? And let me just go over some of these so that because this is kind of the crux of the paper. So conventional financing is defined by who is given the loan. So it's your typical mortgage company, the internet mortgage companies, the fintech companies, the banks, the credit unions. The VA is a special program, it's called Veteran Assistance Program, to assist veterans with purchasing your house, kind of similar to FHA. FHA is the main program that we'll talk about today. This is Federal Housing Administration that helps low and moderate income families. You can also finance your purchase with cash. In Texas, there's another program, Texas Veteran Land Program, that also helps veterans assist with home buying. The owner financing is very rare. Essentially, it's the seller providing a mortgage to the buyer. So the buyer gives the down payment and then gives a regular payment to the seller further on. So this one is very rare. And then there's also a checkbox for other. So I'm going to talk about this more, but we broadly think of the restrictions in three categories. So the most restrictive is cash only purchases. So a seller can say, I will only accept cash offers. I'm not going to accept anything else. Oops. Oh, goodness. Oh, I can't go back. Sorry about that. Let me just do this again. How did I go this far? So the cash is most restrictive. Conventional is sort of the biggest, the most popular way of financing for borrowers. So cash and conventional is the second most restrictive. And then we think of cash, conventional, VA, FHA, or including any of the other programs as the third category. So the most broad definition of, any financing basically is accepted. So This is a new project, so I will talk to you about the main topics that we have explored, and then we'll go from there. So first, I will talk about the FHA program, the background. Then we'll talk about the data, and specifically, we're going to focus on that variable that I talked in the previous slide. So the seller preference for the financing. Then we'll talk about why sellers might exclude FHA borrowers and whether we can see that in the data, whether we can see that the reason is there in the data. And we'll be able to think about what factors affect FHA exclusion. And then finally, we'll talk about whether that preference for financing actually bites or not. So is it cheap talk, or does it actually matter what the seller specify in their preferences? And then I will conclude. And just so I know, do I have until what is it, 10 my time, so 4?
I think so, 4 or 5 or something like that.
Or plus something.
Yeah.
Okay, sounds good. I'll try to maybe wrap up by 4, and then we can ask questions.
So can I ask you questions? I mean, I stopped you
Yeah.
in the middle, but so practically it's legal in the US to say, I don't want to sell my house to FHA. I mean, it's legal to ex ante exclude the part of the market, basically.
So that's the question we're also grappling with. I mean, clearly it is legal to say I'm not going to accept it, and because it's part of the agreement. So
France,
yes, I suppose the answer is yes. There is
in
no
France,
explicit. Yeah. Go ahead.
when you sell your home, it's a very bureaucratic process, very bureaucratic. So you sign a pre-contract. And once you have the pre-contract, the borrower can go to a bank and ask for a loan.
Mhm.
The bank can say no, even though the borrower has signed a pre-contract. And so if the bank says no, and sometimes the bank says no in a complacent way because the buyer changed his mind or her mind, then the seller has to find another buyer. So there is a sort of built-in bureaucratic bias that pushes the seller to pick people who already have the cash, in which case they can pledge that they will not ask for a loan in the pre-contract. And clearly, it's always in the interest of a seller to have such a buyer as opposed to somebody who plans to get a loan.
Yes,
I
absolutely.
don't know what it is in the US.
Yeah, so that's essentially what we're going to be talking about. So in the US, you can be pre-approved for a loan before you submit your bid, but then the property still has to go through appraisal and all the other things. I'll talk about the restrictions of the program in order to have the final approval. So just as you were describing in the US, it's the same thing. You then apply with your specific property and you can still get rejected. So clearly a cash offer is, the best option for the seller.
And then, so what you want to say, like when you say cheap talk, you are worried about cases where I always say that I'm okay with someone coming from that program, but in the end, I will always favor someone else.
No, what we're going to explore here is the kind of the opposite. So you could say that I'm not going to accept any FHA offers, but when we look at the final financing, some of the homes that say we're not going to accept FHA actually do sell FHA.
Okay.
So that's what I mean. Yeah.
Okay, so the other way around, I see.
Mm-hmm.
Thanks.
Yeah. Okay, so what is this FHA program? So Federal Housing Administration was created as part of the New Deal in 1934, and it provided insurance to lenders in the event of borrower default. And all the mortgages that were insured by the FHA were essentially what we're going to call FHA mortgages. And what it did, it created incentive for lenders to originate these qualified loans, because now they could get these very subsidized insurance policies that will essentially make these loans as safe as anything else, right? So in late 1960s, the Congress chartered Fannie Mae and Freddie Mac to do the same thing, to insure mortgages for the majority of the borrowers. And so FHA's primary focus shifted to low and moderate income households. So FHA program is now, as it is, designed to help lower and moderate income households and those who are first-time home buyers to buy homes. And right now, FHA requires that mortgages that it insures are standardized. So one, lenders must follow FHA underwriting criteria. So this is about the borrower, and we're going to talk about what they are in the next slide. And then also the property that is purchased with the FHA funding requires standardized appraisal, which we'll also talk about in the next slide. So they, in addition, introduced a variety of rules and regulations to prevent fraud, basically predatory lending practices and fraud. So what are these eligibility criteria? So for borrower eligibility, the credit score has to be above 580 to have a 3.5% down payment, or as low as 500 with 10% down payment. So typical, conventional loans, you have a 20% down payment. So this is a huge reduction in the money that is expected to put in up front to be able to purchase the property. And also these credit scores, just for your reference, are very low. The average credit score in the US is 715, I believe, in this year, and they range from 300 to 800. So 580 is quite low. The borrower also has to be a first-time home buyer, so there's some certainty there, and there's debt-to-income ratio that has to be satisfied, which is probably the most binding constraint and why most people get rejected if they get some income shocks during the time of the search for a house. So properties also have to pass some eligibility criteria. The most notable and the most explored one in the literature is a loan limit. So properties have to be below a certain value to qualify for this program. So there's a national limit in 2022. So this year, the limit is $420,680. And then there's adjustment of limit for the high cost areas. So the high cost areas, the limit is higher. In addition to this loan limit, to qualify for the FHA program, the house has to pass the FHA approved appraisal. And during this appraisal, there's three main parts that are evaluated. One is the physical structure, so there has to be no major damage to the structure. So no damage to the roof, foundation, exterior. There has to be adequate ventilation, no insect infestation. So as you can imagine, there's the reason is you don't want to subsidize purchase of these highly constrained borrowers to buy something that is going to deteriorate and is going to need a huge influx of cash to fix to maintain property value. The property also has to be livable, so it has to have working utilities, no lead paint, all the safety codes have to be met, fire safety, etc. And then the appraisal process examines the site to make sure that there's no contamination in the soil. The other restrictions are mainly targeted towards reducing fraud for the policy. So flip properties are no. So if you buy a house that was bought less than 3 months ago, then you're not eligible for FHA funding. So you have to, this property has to have been bought more than 3 months ago. So the reason is a lot of people, they bought house basically really cheap, then they sell it at a lot of higher price using the FHA loan, and they pocket the difference. So they kind of, the fraud came from working with the flipper anyway. And many condos also don't qualify. So if you have a building with many apartments, there has to be a minimum number of units that can be, maximum number of units that can be financed by FHA. So just to show you how big the program is, so this is plotted here as the FHA share of new purchase loans. And you see that, you know, in the early 2000s, it was smaller, but still, you know, an important program. So about 10% of the homes were purchased with FHA loans. Then let me talk about this period as well. So what was important during this housing boom in the US in the early 2000s is that there was a lot of credit, subprime credit available to borrowers, to low-income borrowers. So they had basically an alternative way to finance their home relative to FHA. And then what happened in 2007 and 8 is the housing crash and the subprime credit completely dried out. And so FHA program stepped in and was the only way for low-income families to afford a purchase of the house. So you can see that the share increased to up to 30%. And now it's about 15% of all mortgages. So a very large program.
Can I ask a question on 2008 and 9? So like the share increased a lot, but did the numerator, I mean, it's a numerator, it's a fraction thing, right? So also I guess the absolute value of new purchases went down a lot.
Yes, yeah, I could do it as a share, as like the volume of.
Yeah, because I guess I mean, is it like just they just went down, but by less than non-FHA loans, or
Yeah. So the remaining of the loans are you know, conventional, mostly in cash. Yeah.
Okay, thanks.
Okay, so why would sellers not want to work with FHA borrowers? So this is something that we will explore in this project. So one thing that we might be able to look at is whether FHA approval process is longer. So if you buy, if you sell to a cash buyer, maybe, you know, you find a buyer, there's no contingencies, you can just set the closing date right there and sell the property quickly. Maybe the FHA approval process takes longer and there's delays associated with it. So we're going to be able to look at that directly. The other thing that is a potential reason is there's more uncertainty with FHA appraisal. So because there's these additional hurdles, maybe the property might need additional work to qualify. So, you know, the appraisal might come back and the seller might need to do some more work to make sure that the deal actually goes through. On the other thing that might happen is that the loan is rejected flat out. So you find a buyer, the buyer then, you know, applies for this funding, the loan gets rejected, and now the seller has to go back and find another buyer. So this looks pretty bad because, of course, it sells a signal to other buyers that maybe something was wrong. So you definitely want to avoid that situation as a seller. The other thing that we thought about is maybe this is not specific to FHA, also applies to any financing option that has a cutoff in price. But maybe there's some negotiating power that the seller loses if they work with FHA borrowers, if the house price is close to the qualifying cutoff. So these are borrowers that can't necessarily add more of their own money if the loan amount that they qualify is lower than the price, right? So if there's discrepancy in the appraisal value, then the seller might not have any negotiating power. And then, we talked to actually a lot of real estate agents about this, and what they tell me again and again is, oh, we try to convince our clients that FHA borrowers are great, but the sellers have this perception that it's a hurdle, so they don't want to deal with it. So that's another reason potentially that we don't know in the data, but maybe we can look at. We can think of in the back of our minds. Okay, so let me now go back to the data and exactly we're going to measure in the sample that we're going to look at for this project. So the data comes from this company called CoreLogic that collects listing information from these multiple listing service platforms. And we do have close to 150 platforms to look at, but these are enormous data. And so for now, because we want to explore time series variation, we focus on one of the largest platforms that we have in our data, which is the Houston Association of Realtors. So what really big city in Texas. So, you know, we see a lot of patterns in there already. So we're going to use listings level data from 2000 to 2020. We have all of the property characteristics. So we know the exact address, number of bathrooms, bedrooms, square feet, garage. There are hundreds of variables that you can see. Basically anything that you find on Zillow or on the website that markets the house for sale is available to us and more. We also know listing characteristics. So we know the date of the listing, we know all the prices associated with this, we know the sale outcome, and we also know the in-contract date. So we know the date when the buyer was found, and we know the closing date. So this is going to allow us to measure this delay between when the buyer's found and when the sale actually happened. And most importantly for our project, we have this financing variable, which is the preference of the buyer, of the seller on which financing they will accept. And we also have, it's self-reported, but we have sold financing. For the properties that sell, we know exactly what financing was used for the sale. So because we want to focus on the seller exclusion channel, the sample that we're going to talk about today is going to be maximally, you know, we don't know exactly, but we're going to try to only look at the properties that would otherwise qualify for FHA, okay, or at least have the potential to qualify. So we're not going to look at condos because condos have a lot of restrictions, only single family residences. We're going to look at, we're going to restrict houses that have a reasonable list price. We're only going to look at homes within the FHA limits, and we're not going to look at short sales at all. So we have 1 million observations as a result. In addition to this data, we'll also look at HMDA data, which are, you know, is going to give us mortgage rejection rates across different programs. This is at the count, which, well, the original data is at the loan level, but we haven't done the merge. We're just going to look at the county level for now. We also have some demographic variables. And of course, to get the loan limits, we also need the FHFA data. All right, so this is the most important graph. So here I'm showing you the breakdown of this preference for financing variable. So as we talked about, the cash only is the most restrictive preference for financing. So that's the blue line. So there's relatively few sellers or listings that ask for cash only borrowers. The next most restrictive is cash conventional. And that's the faint orange line. And then VA is cash conventional VA is kind of also very small, so we're going to ignore it. Cash conventional VA and FHA is the most broad category, right? So that's the thick thick orange line. So what do I want you to take away from this graph? So prior to the housing crisis, there was about a 50-50 split between whether the sellers will accept FHA or not. And remember, this is these houses are already eligible. Well, according to, you know, what we could do in our sample, we think all of these houses are eligible for FHA financing. So only about half the sellers said they want to deal with FHA buyers. Now, of course, a lot of these buyers, as I mentioned before, also had access to subprime mortgages. So there was a way for them to draw in those buyers with other financing opportunities. Now, when the crisis hits, all of a sudden you see an increase of the share of listings that is willing to accept FHA loan. And this is we think precisely because, the subprime market had completely dried out, and now to draw in those borrowers, you have to accept FHA funding, which is the only way for them to buy a house. Okay, so we see that this FHA exclusion had gone up a little bit recently, but not by that much. So we think it's a really interesting pattern to explore. So for the rest of the talk, I'm going to go over kind of how we can justify why this bold orange line is not 100%. Why don't all sellers accept FHA financing? All right. So
Sonia, if I can ask a question.
Yes, of course.
So I know you're analyzing only Texas. Do you expect the same pattern in different MSAs? And you think it depends also on, the housing bubble of each MSA as well?
Yeah, so just eyeballing that graph for different MSAs. So the reason why we chose Texas is because it had kind of the clearest. A lot of the times they fill this field by hand. So it takes a lot of work to parse it out. So in Texas, it's very clear. And there's also very few missing observations for this variable. In most other MSAs where we have the majority of listings with this field filled in, we see a similar pattern around that time. So it would be interesting to explore kind of the magnitudes and how they differ by different locations, for sure. Yeah.
Can I also ask? I guess it's not really a related question, but I still don't understand. Like, so I am a seller.
Yeah.
It seems to me that it's a dominant strategy to say yes to the question on the listing, and then I can always reject the offer if the offer come from a. So how come that it's not always one?
Yes, that's a really good question, and that's something that we're grappling with, because it doesn't bind you to say I'm gonna accept.
Yes, that's why I don't understand
right?
why people don't say just yes.
Exactly.
Does it mean maybe
But
the
problem
broker?
is,
For the broker,
so
maybe it's more work to also deal with the FHA, and so it is the broker who is the decisive and who says, okay, say yes or no to this question. Could it be?
So yes, we're gonna basically find that agents explain a lot of this variation. But to answer your question, but even for agents, their goal is to sell the property.
Yeah, but for them, maybe it's more work if they have to deal with a lot of guys who
That's
eventually
true,
reject
yeah.
it. So maybe it's not so.
So the problem is that if your only bid is an FHA borrower and you didn't specify that you're not going to accept it, then you're kind of bound to give the agent their commission because they have found you a qualifying
Okay,
buyer.
so that is a cost. I see.
So it's kind of hard to reject the FHA bid if that's your only option. So that's kind of the only thing that we came up with as a reason. Yeah.
No, but I guess that's significant because the fees are not so little, right? So.
Yes, yeah, exactly. The fees are 6%, basically.
Yeah. Okay, thanks.
Okay, so here's the distribution of delay between when the buyer is found and when the closing date actually happens. So for cash offers in blue, you see that the distribution is shifted towards earlier. So a lot of cash transactions close very fast after the buyer is found. The other thing I wanted to show you here is that VA loans and FHA loans are pretty similar in delay distribution, but they're a little bit slower than the conventional loans. So there could be, this could be part of the reason, and the tail is a little fatter, right? So it could be that, FHA loans are associated with a little bit of a delay. It's not huge. If you look at the CDF distribution, if you look at the median, the 50th percentile here, then you see that, most of the half of the cash offers sell within, less than 3 weeks of the buyer being found. And then the difference between conventional and VA FHA is probably like about a week, 5 days. Okay. So there's some delay, but is there also uncertainty associated with whether the loan is going to get approved or not? So we don't know this or at least for this stage of the project, we don't know exactly loan level approval rates, but what we can do is the average approval rates by the program in a particular county. So the main county that is part of the HAR geography, the Houston Association of Realtors geography, is Harris County. This covers all of Houston. It's the third largest county in the US. It has about 4 million people living in it, just so you have an idea. So here we're plotting the fraction of loans that get rejected based on the type of financing that was in the application. So prior to the crisis, the FHA loans were actually rejected less than the conventional loans. We think it's partly because of selection. So, you know, a lot of the riskier borrowers were probably using subprime mortgages. So these were kind of safer borrowers that used FHA. And the subprime borrowers are part of this conventional application pool. So, you know, the rejections were higher in conventional mortgages because it included a lot of these subprime borrowers. Now, after the crisis, there aren't a lot of subprime, there basically are no subprime loans in this conventional pool, so the rejection rates go down and the FHA rejection rates go up, and, you know, consistent to the idea that maybe the property or the borrower is more likely to be rejected as an FHA borrower. And then we looked at prices. So here I'm plotting the FHA allowed, which is a 0-1 variable of whether the listing allows the FHA loan, against the relative list price relative to the loan limit, right? So loan limits are different across different counties, so it's important to do this correctly. So because we only look at the properties that are within the loan limit, the maximum is 1. But as you can see, you know, the really cheap properties, or the ones that are you know, farthest from the loan limit, are less likely to accept FHA funding. And then kind of in the middle is where you're most likely to accept FHA. And as you get closer to the cutoff, you're again less likely to accept. So if we zoom in and restrict it to, you know, properties are at least half of the limit, you can see that the probability that you accept FHA goes down pretty significantly as you approach the limit. So maybe negotiating power actually does have some bite here. Okay, and so the other thing we did is we kind of threw everything into a regression and regressed this variable of whether you accept FHA funding or not. So this is excluded or not on all the different variables. And I think there's a lot of work to be done here still, and we don't know exactly, you know, whether we've included all of the relevant characteristics. So I want to focus for today on these R-squares, or the explanatory power of including kind of different fixed effects. So if you just include all of the controls that we have, the demographic controls, the rejection rate, the median price, the average days on the market to proxy for how tight the market is, it only explains about 9% of the data. If you include location fixed effect, it also is not that helpful in explaining the patterns. However, when you include the office and the agent fixed effect, so to Axel's point, it now starts to be very significant in explaining the variation. So 40% of the variation is explained by who is your agent, right? So maybe the agents have different strategies of whether, you know, they advise their client to accept FHA funds or no. And then if you include agent by zip code, that improves the R-squared to 54%. So in a sense, maybe agents have different strategies by location where they work. So I see that there's some chat, but I can't see it, unfortunately. I'm going to look it up after. But feel free to. Okay,
you can ignore the chat.
Okay, sounds good. All right, let me just show you lastly, whether we also have this final financing recorded for most of our observations. So after 2015, the data is pretty bad. This is a fraction of missing observations, but pre-2015, we have a pretty good breakdown of what the final financing was for the listings in our data. So again, to remind you, the blue is cash, the light orange is the conventional loans, and you see, you know, a lot of the purchases were made with conventional loans, and then the crisis happened, and then those go down. There's basically the subprime market dried up, and then the FHA loans, again, a pretty small. This is the graph that I showed you, essentially the graph that I showed you earlier for new purchases, right? So we can break this down into whether you initially thought you were going to accept FHA financing and not, right? So this is going to be like a lot of lines in the next graph. So I apologize about that. But basically the shaded ones are the breakdown for the ones that only accept cash and conventional, and the solid ones are the ones that also accepted FHA. Okay, so this is a lot. I'm just going to focus on this share of FHA funding based on whether you accepted FHA or not. So let me show you the next slide, which is just the blue line here. So as you can see, when you said that you're going to accept FHA, that's the solid line, you're more likely to end up with an FHA loan. But if you said that you're not going to accept FHA, you still sometimes end up with an FHA borrower. So it's not a hard constraint of your preferences that you specified, but we review it rather as a soft constraint. So let me just conclude here.
Then given that, and to go back to what you said earlier, then like you actually always want to say no to the question, do I want FHA? Because then you will have it anyways.
You can have it anyways, it seems, yes. But as an FHA borrower, so the reason why you might say no also is because your property ex ante might just not qualify, right? So let's say the limit is higher. And so when FHA borrowers are screening for available housing, they might actually not see your property at all if you say that you're not going to accept FHA funding. So it's an interesting variable that we think it's, I mean, I think there's like a search paper here that we can.
That's exactly what I was saying. Then maybe you want to write a paper with search frictions, and then you can quantify the different.
Yeah, so I think that would be really interesting. But we thought first order was to look at kind of whether we can find a measure of how FHA borrowers are excluded from the market or not. So that we thought was the first order. And then I think there's a lot of interesting questions we can also ask with this data.
Sonia, I was thinking, like, is there any way to construct, you know, an index of sort of hot market versus cool market? You know, like some sellers can afford to say out loud, I'm not going to take FHA loans. By the end of the day, like this graph is showing that, right? If that's my only buyers, I'm sure they'll take them.
Yeah. Yes. Yes, I think this could be embedded into this, and also, you know, this is kind of the idea of exploring the time variation, where we can think of the times when the market is hot versus the time when the market is cool, but we can also look at regional variation as well. Yeah, absolutely. Yeah. So let me conclude. We have this very unique measure of seller preferences for financing that comes from multiple listing service data that hasn't been explored yet. And it points to the fact that FHA borrowers are excluded from a very significant portion of the market, especially during housing booms. And it shows that sellers are particularly reluctant to accept FHA financing when other options for financing are available for potential borrowers who would be qualifying for FHA programs. And we also see that, sellers are less likely to accept FHA financing or say that they accept FHA financing if the property is priced near the FHA eligibility cutoff. And we also found it really interesting that real estate agents explain a significant portion of this variation in this financing accepted variable. So there's potential role of intermediaries in exclusion of FHA borrowers from a portion of the market. And I'm happy to stay for questions, but I know it's break time, so I give the floor to the organizers.
Thank you very much for this presentation. And maybe again we can have 1 or 2 questions.
I'm actually curious about the short sale market, at the crash. Do we see an uptick in FHA mortgages?
So we excluded short sale for this analysis.
I know you did,
that,
but I'm just kind of curious.
If we just focus on short sale, do we see that the FHA borrowers had the opportunity to buy these like cheaper properties? Is that what you mean?
I'm just curious. I mean, that's another dimension of trying to see, right? If there's any sort of, is this kind of aggregate market of financing opportunities?
Yeah.
That affect this kind of options, yeah.
I think we're going to have to dig in a little bit more because the short sale properties are probably more likely to have some sort of major issues with them. They might be deteriorating. So we'd have to look at maybe the description of some sort of, we also have the listing description. So see whether we can only look at the properties that would qualify.
Okay.
Yeah.
All right, so we can restart. So the format is the same. So the first talk will be for 45 minutes until 5:15. And you can ask questions during the talk. And so Carlos, the floor is yours.
Thank you, Sel. Thank you for the invitation. Thanks everybody for connecting. Feel free to interrupt. This is joint work with Aaron Hedlund, my longstanding co-author. This is a project that we've been working on for a while, and we're trying to finish. I guess this is an old question. We're trying to address how important is housing finance in kind of shaping boom and bust episodes, and for people that are working at the central bank, like Wenli and me, to what extent these generate some financial instability or macroeconomic fragility. So part of this agenda is trying to connect housing and housing finance with economic performance. Pedro of Gete, I think, has a paper forthcoming Review Economic Studies that also tries to assess to what extent this debt overhang affects economic recoveries through housing and investment. So I think there is a literature that is growing, and there's other work, but I think it's something important, at least for people that work at the central bank. A lot of people pay a lot of attention to what happened in the United States in the early 2000s, but boom and bust are not a phenomenon unique to the United States. When you plot for the last 50 years what has happened across country, you can see that if there is a pattern, is that house prices have been far from stable and interesting. You can really see rapid booms and collapses of prices. And in some cases, in countries like Australia, New Zealand, or in some places in Canada, you see steady appreciation for more than 2 decades. So these are things that are kind of puzzling from at least a macroeconomic perspective and the asset pricing. And most of these things, what they seem to have in common is some regularity, that there's some credit expansion, and at the heart of it, you have low cost of borrowing, and the return on other assets are kind of low. That's often defined as low return from safe assets. So I think that is kind of important. This paper is going to focus essentially on the US episode. We have a companion paper where we address empirically what has happened in other countries, but I would argue that this is unique, especially in Europe. You have very different performances in countries like Spain, Ireland, as well as France. Lately, Germany also had booming prices, which is something that is unprecedented. So I think these are all very interesting episodes. And what we're trying to find is kind of common patterns that help us to understand these features. So this is part of a broader agenda. You see that there's a bit of an application trying to develop at some point something that you may want to call a unified theory that tries to address everything. But I think we have kind of bits and pieces, and we're trying to put these bits and pieces together sequentially to move things forward. But in a broad sense, from this, again, relatively young literature of macro housing that is less than 2 decades old, or real estate or housing finance agenda, what we try to address is essentially what moves house prices or what moves real estate markets, but essentially a combination of prices and quantities, which is, I guess, the ultimate goal in macro, being able to have a theory that explains both prices and quantities. And I think real estate or housing is a key market or key area to understand these things. And when you think about this, you have the obvious candidates that people in areas like urban economics have been trying to emphasize for quite a long time. When we talk about fundamentals, we often think about population growth and demographics, or preference per particular location, or changes in income across location that move people around and move prices. Those are usually static models, and they don't really have a lot of role for dynamics. You're really comparing steady states. When you move into macro, this is not an issue for this crowd, but you really have to start thinking about expectation. Information about what's going to happen in the future is going to shape what we see today. And these things are often capitalized in house prices. So expectations are going to be important, and you're going to have to define expectations about potential changes in fundamentals, but also something that I have emphasized in other work, expectations about not just current credit conditions, but our future credit conditions that affect future valuations. And this is kind of a straightforward thing to think about it, but I think it's just important. It's just not about contemporaneous credit conditions. And then something that I have also addressed in other work, but I think it's going to be a key component on the piece that I present today. It's this notion that, when we think about housing, it's convenient often to think about market that face some frictions in buying and selling, and devaluation may not be a good way to, fully think about it. And so the notion of liquidity really means that there are some periods, in particular the one that we saw recently, at least in the United States during the pandemic, that housing becomes a hot commodity and everybody is rushing to buy housing. It's a very liquid market. Anything that you put in the market sells, in most cases above asking price. And there's periods like in 2008, 2009, where there's very few buyers and there's a lot of sellers. And despite the fact that the price has adjusted downwards, there's just not a lot of action in that market. And I think those are important components. In financial markets, they talk quite a bit about liquidity, but what is important here is to think about the liquidity being a key driver in the valuation of prices. And when the asset is very liquid, then it's traded really well. But when somebody buys an asset that I think is going to be difficult to transact in the future, your willingness to pay for that asset diminishes. So you want to buy at a discount. We're going to take kind of a macro approach, but you can think about pushing this thing to a more disaggregated level by looking at cities or regions in which the notion of liquidity varies. You can think about some areas in which the market is always fairly liquid, so people are willing to pay because at least the expectation is that they can liquidate that asset in the future if they need to, because of other needs, because of demographic factors of aging, that they can unload the asset fairly easy and for a fairly stable price versus other markets that are very liquid. So I think those are going to be things that are going to be important in the valuation. So what I wrote here is, a standard notion of asset pricing valuation. You can think about the fundamental as what they define in the literature as the user cost, that basically the fundamental price, it's the cash flow that you get today, the rental value of having access to the asset, the consumption flow, plus a resale value. And then what we have added here, it's, I guess, a couple of these friction components. One is this notion about expected liquidity on the resale value tomorrow. And then the access to credit is this notion that you can collateralize the asset. So you don't really need all the income today to purchase the asset. You can use future income to, kind of pay it off. So I think these are going to be two essential components that I'm going to be talking about today. So the key thing in today's presentation is that we're going to develop a fairly standard off-the-shelf model of incomplete markets, and we want to assess, the impact of, financing at the individual level, but also the macroeconomic implications. And so the hope when we think about the agenda is we want to understand what drives house prices, to what extent these house prices affect financial markets and macroeconomic aggregates, such as aggregate consumption, residential investment, among the key things. And then the final one, which is important for people at the central bank, is what are the policy implications for the movements of these asset prices in either direction, up and down, as well as the impact in the macroeconomic variables. Is that something that policy should be concerned? And then we're thinking about potentially two dimensions. One, it's obviously monetary policy. You can also think about fiscal policy, as housing is an asset that is heavily subsidized, but you can also think about macro-prudential policies connected to, potential financial fragility. And that idea comes with the idea that there's going to be a cross-section distribution of leverage connected to the assets. So changes in the value of the asset may generate a mismatch between the individual balance sheet, and that can generate unstable payments and potentially defaults. And that's going to be a key issue in the study that I'm going to be talking about. So this is kind of a general picture. The question today is more connected about housing finance. And what I kind of want to lay out is that in the standard framework, when we think about buying and owning and how to finance it, the cornerstone model, the user cost model, has Modigliani-Miller implications. Buying cash or buying financing should yield the same results from the individual perspective. The individual wants to buy the asset or wants to rent the asset, so that decision is indeterminate, and the financing is also indeterminate. So that's kind of the starting point for most of these macro models. You take a rep agent off the shelf, and that's what you get. So in order to get some meaningful action out of housing finance, you need to start introducing friction. So we're going to introduce several frictions. One is going to be incomplete markets. So that's going to be a key one. The other one is going to be the fact that households can default on the loans if at some point they find that beneficial. So that gets around Modigliani-Miller, and I'm going to explain in a second how do we also adjust the margin between buying and owning. But the bottom line is we want to move away from Modigliani-Miller. We want to have financing decisions being a key component of the decision to buy a house, and we want those financial decisions potentially to affect financial, stability. So everything that I'm going to be talking about today is how different features of mortgages or financial contracts to purchase a house have an impact with the macroeconomic performance in response to the same shocks. So that's going to be a little bit the nature of the game. And I want to kind of reemphasize one more time that if markets were complete, none of these things would matter. So the fact that these things matter, it's just because you have some market incompleteness, some friction. Some of those are kind of hardwired into contracts, and I think it's important to understand, because when you compare across countries, you could argue, well, there's some countries that have fixed rate mortgages. So when you have interest rate resets, they don't really have sensitivity. All the countries, Europe, for example, Spain and the UK have floating rates. So when you change the policy, that changes the rate, not only all the mortgages, but on the new one, on the old ones. So these are going to be the things that we're kind of going to be looking at it. If you can insure all the inflation risk and all the interest risks, none of these things will matter. So I just want to make sure that I kind of anchor the ideas, because the name of the game today is going to be fairly simple. We're going to take a very standard economy. We're going to expose them to the same set of shocks, but we're going to be changing the nature of the contracts that used to purchase house. That's why we have the housing finance. And we want to see how that propagates into the rest of the economy, in addition to, affecting house price dynamics. So I just want to make sure that that's clear. And because we're going to be living in a second best world, one can think about potentially macroprudential policies. And I think those are going to have some interesting redistribution issues. And these are some of the things that we're currently working on. When we think about contracts, we're going to be thinking about, three key dimensions. An important one, and the US is kind of an awkward case because the US is a mix of fixed versus adjustable rates, whereas in Europe, traditionally, countries are a bit more divided. You have countries like Germany and France that they tend to be more fixed rates, and countries like Spain, Italy, Netherlands, and the UK that are floating rates. So those are going to have different policy implications. Another key difference is in markets like the United States, extracting equity when you have capital gains is not very costly. Whereas in other countries, if I recall, like in Germany, extracting equity is very complicated because you sign a contract and you have to honor that contract termination. So the lender is really not pricing equity extraction. And that changes because if we're thinking about households that may face income risk and they have rapid appreciation, they may want to rebalance their portfolio to guarantee a certain level of consumption of durables versus non-durable goods. So it's important. And what we'll see, and I'm just going to key off some of the key findings, is when you have a loan and you are subject to appreciation and you can extract some equity out of that appreciation, you're willing to pay more for the asset because the asset has a higher degree of liquidity, even when refinancing has a cost. It doesn't need to be for free. Of course, if refinancing is costly, you're willing to pay more, but that's going to be important. Another aspect that I think is critical, and it is something that is related to some work that I've done, in the past for quite a while, is the notion that these are long-term contracts. And when you talk about long-term contracts, you're going to have a stock and a flow. And when you reduce the duration, you're essentially exposing people to rollover risk, which is a well-understood problem in sovereign debt when you're talking about one-period loans. But when you're talking about mortgages, the fact that you sign a long-term contract, in most cases nominal versus real, today we won't be making a distinction between nominal and real. There is going to be a whole real economy. This is going to be critical because households don't have to anticipate to what extent in the future that short-term rate could be much higher than what they paid before, which would have implications for prices, and that kind of connects to the expectations. So I think these are important margins. And then, of course, a big discussion, at least from the macroprudential policy angle, at least in light of what we saw in 2008, is to what extent we should have loan-to-value caps, where those were to relax. We heard a lot of stories about LTVs exceeding 100% for some borrowers. And 2 floors up, we have the team of financial supervision, and they do pay quite a bit of attention to what extent financial institutions are overstretching their credit to less than credit-worthy borrowers. So that's an important component to what extent you can limit some of it. And one way to think about it, it is related to some work that Pedro Gete has done, is you're really trying to control expansions on the supply of credit, even when rates are low. So you can reduce the rates, but you can, control how much flow of credit can go out by reducing the LTV. And then another important one that really limits cash flow payments. And this is the idea that lenders want to make sure that in the worst case, even when income falls, borrowers can pay their credit, so they're credit worthy and they can service the debt. And they put some credit to payment to income constraints that try to limit that. For those that don't really follow this thing closely, normal values are somewhere between 30 to 35%. For people that refinance, they tend to be lower because the loan amounts tend to be not as high. They've been paying them off, so those could be below 30%, 20%. And then for those that overly stretch, in some cases first-time buyers, those numbers can exceed 40%. Usually the limit is around 45%. So I just want to kind of put those numbers out there so people have a little bit of perspective, if that makes any sense. So what I'm going to do next is I'm going to describe the model at a very high level. I'm not going to give a lot of detail. I'm going to show a couple of Bellman equations, key things on how to close the model. And most of the presentation is going to be basically talking about boom and bust and what are the implications for the macroeconomy and making adjustments on housing finance to basically show up, how things change. If anybody has questions about the model, and I'll be more than happy to address those here. There's just a lot of detail, but I just want to give kind of a high-level presentation because I think the key meat and potatoes come from the implications of what the model can generate, and I can connect features with implications without getting into a lot of modeling detail. We try to come up with a model that has the minimal set of ingredients, but still a fairly large and rich model. But I think each piece is kind of necessary. We're not going to go life cycle. This is something that I've done in the past, and it's just important because it generates a housing demand that varies by the life cycle. We're going to take kind of an infinite horizon. And the key difference between this framework and the more traditional incomplete market is that now consumption comes from 2 sources. One is going to be kind of a perishable good, which you're going to call CTE, which is, you can think about food or other type of services that you purchase every period. And then CH is going to be the component. And you can think about that being kind of a durable good. And there's 2 ways to get that second good. You can actually rent or purchase that from the market at every period. And then you can buy the asset, and that kind of gives you access to the good immediately. So that's another way to get that good. Now we're going to have to make some assumption, and these are, where some of the approaches kind of, diverge. But our view is that there's some distinct feature of units, the ones that you rent and the ones that you own. And you can think about this thing almost like pre-Airbnb, but the idea would be the ones that you tend to rent, what we call them apartments, are they're small in size. The ones that people tend to own are larger. This may not be good representation for Europe because you have a lot of mixing buildings like combined rental versus owning. But in the US, when you look at the average rental unit and owner-occupied unit, there seem to be quite distinct in terms of size and geographical location. The average rental unit in the US is less than 100 square meters, whereas the typical owner-occupied unit is about 200 square meters. So in terms of size, you could argue that these two are different. And what we're going to assume is essentially
so in reality, it might be a feature of the equilibrium, right?
I completely agree. And
if you are assuming that these are two different goods, right? There is no overlap in size at all, by assumption.
That is correct. That is correct. And we're going to make it even more boring. We're going to make it really boring because we're going to fix the price. We're going to fix the price of rental units via technology, and we're going to have all the action in the house price. And then more than happy to discuss what that implies. I have written some other papers where we basically endogenize that, and that's a feature of equilibrium where we have a supply of rental apartments that could vary in size. And that is an equilibrium, but that requires to bring a bigger apparatus, which is interesting. But for the question at hand, we want to put all the weight into try to understand how changes in housing finance affect the price of the asset without thinking too much about what kind of action it has on the supply of rental. That's a bit of a draconian assumption. If I was going in Europe, I would be a bit more worried, and I would have to, and try to endogenize the rent. And we've done some extensions where we do that. Today, I guess, bear with me, we're gonna make that action less interesting, and we're gonna put all the eggs into the buying dimension. I think for the US, it's a decent description for the nation as a whole, but as you get more granular into certain markets like San Francisco, New York, you may be closer to what Paris, Madrid, or Barcelona look like, or London, as opposed to the US as a whole. There's a lot of discussion about how that segmentation affects the result. There's some other papers that explain that. There's a JP by Kaplan, Minman, and Violante. They take a different approach. There's a new paper by Adam Gooden and Daniel Greenwald where they explore some intermediate degree of segmentation, and they're more accurate estimates kind of point out segmentation. It's a very rich area to think about it, and I would not claim that there's kind of a universal fact that really covers all the geography at a global scale. The key thing here from the household going to the incomplete market framework is the fact that individuals are going to have persistence and transitory shocks. So the idea is that you could be doing pretty well on average, but that period you could have a couple of negative transitory shocks, and you have to make a decision: should I default based on my transitory shocks or not, or do I have to make a decision based on a significant decrease on my expected future income? So most of the action is going to come from playing with the income risk that individuals have, combined with the appreciation or depreciation of the asset. The technology side, we have experimented with different ones, but ultimately we settled with a linear technology to produce the non-housing good. So that's going to be a very simple linear technology in labor. We tried with capital and didn't quite get a lot of interesting action. So we try to simplify that. So we're going to put more action into housing. The key idea here is you're going to be producing that composite good that we're going to call goods and services, and rental services are going to come out of that technology. So we're going to take part of that good, and there's going to be a set of agents transforming that into housing units for rental occupy. And that's just going to generate basically a rental supply that is elastic, and the prices are going to be determined by technology. The reason why we take this approach is that at least in the US during the housing boom, there's a weak correlation between rents and house prices, which is kind of puzzling. And if there is some correlation, it moves kind of the opposite direction. When house prices go up, rents go down. And when house prices go down, rents go up, which really it's counterintuitive from the user cost framework. What we're going to assume is, since the correlation is negative with prices, but it's not very strong, we're just going to keep rents flat. And what it does is, it really helps you to compare the impact of housing finance directly in prices, and it does not impact rents because you may have inflows or outflows coming in and out of the rental market. So I'm not arguing that that margin is not important. What I'm arguing is I would like to do a clean comparison where the effect of housing finance are really loaded into house prices, not a combination of both moving and then trying to tease out how much is a result of inflows or outflows from owner to rental occupied housing. So you can think of it as a semi-general equilibrium where one price is fixed and the impact is going to be capitalized all in the other price.
Is YH a flow or
YH is going to be endogenous. YH is the amount of goods that go to
the
rental.
stock of housing or flow of new housing?
The stock of, so we're going to take we're going to push it even forward. The stock of owner-occupied housing is going to be a stock, and you're going to be producing more houses at every period using labor, structures, and land. Rents are going to be a flow. There's not going to be a stock of rental units. You're going to be consuming it, and you're going to perish it. There's other ways to do it. Yeah. So for renters, essentially everything is a flow.
So it's like the 3 piglets or whatever.
Well, what it makes it
You have a
is
straw house that you rent.
That's right.
And
That's
a
right.
brick
And what it
house
makes-
that you sell. Right?
That's right. The owner occupy, I mean, the US has essentially 2/3 of people being homeowners. Countries
I
like
mean, in your
France,
model, I'm talking about your model. And,
in the
and
model, the rental,
YH is the production function for new brick houses that are sold.
that is correct. That is correct. The goods sector produces the bricks and they combine them with labor and land and they generate new houses. The YA are the apartments, and that is a flow that you take out of the same
straw.
production. Yeah, that's a straw. Yep, that is correct. We have a version, but it gets a bit more messy because there's more moving parts, and then you have to keep track of another vector you have to clear, which is the rental market, and then the endogenous stock of rental units, and then who gets to own it. So we are working alongside getting a model with investors. Here, this is essentially one way to put all the effort of housing finance in the price of new residential investment with owner-occupied purposes, if that makes any sense. There's different ways of closing the model. We have experimented here with different versions, but I think this is the cleanest ones to make our point. Is that the complete story? I would argue no. I think more work needs to be done, but I think this is sufficiently at least to give us some indication to what extent housing finance is important. And I think that's hopefully the most valid lesson, trying to basically point out how important is housing finance and what are the implications.
Can I ask a quick question on the production side? So you don't have capital, but you're going to, I'm just trying to get a sense of what is if you're matching well the non-housing to housing wealth at the household level, even if you don't have capital.
Well, that's a good question. We're gonna have a liquid asset that people are going to save, and that's going to be capturing part of the wealth of the individuals when we try to basically match the data.
Okay, so you're gonna match to the SCF.
Yeah, but I mean, it's becoming more and more popular in macro models to assume a global interest rates, and at that point, then the curvature of the production function becomes less important because you're going to have capital inflows or outflows, and using a bond would essentially give you the same type of results. We're going to basically fix the interest rate again. That's going to be useful because what it really allows you to do is control to what extent the interest rate moves in the direction that you want it to move, but it's not moving endogenously through changes in savings. So it really gives you a clean identification of what are the effects of housing finance, because across the experiment, the interest rate, when you compare adjustable versus fixed rate mortgages, does not change just because the interest rate endogenously changes. Again, this is a model. If you want to think about biases, the whole bias is how to make house prices to move. To put a little bit of background, and maybe it sounds like, well, that's excessive. Well, what has been a challenge for the last 2 decades, although I think we got to much better, is how to get prices to move sufficiently. So if you think that the buyer is a little bit malicious, if you want to use that term, it's just because in the past we failed to get house prices to move more than 10-15%, and during the booms it goes exceeding 30 to 40%. So the question is, if I give it the best shot, how much can I move it? And what you'll see is we'll get close or exceeding these big numbers. So I think that's going to be the key thing here. And then we can modulate this thing down by, dampening the effects by having rent or the interest rate being endogenous. You know that some of these things may end up going in the opposite direction. But at least you know that you can hit these big numbers, and then you can start making corrections if those are kind of unappealing assumptions, if that makes any sense.
I see. Thanks.
But that's how we approach it. A couple of quick things describing the model, and then I'll show you a couple of value functions. But essentially, the key thing is when you borrow, we try to capture this idea that when prices drop, you can default. So there's going to be kind of a banking sector that issues bond, and that's what people is going to hold. And you can think about those deposits giving an interest rate and it's giving mortgages. There's two things that I already mentioned that are going to be important. One is those mortgages are long-term. And when you go long-term, a key component that I think you get as a byproduct is a distinction between stocks and flows of credit. The stock is substantially larger than the flow. So you can have small origination flows, but a humongous stock. And when you look in Europe, the ratio between the stock and the flow varies quite a bit. You look at countries like Spain, and the ratio between the stock and the flow is about 20. In countries like Germany, it's about 5. So it gives you an idea of duration of loans and activity. And he also separates down payment versus collateral constraint, which is something that you cannot do with short-term credit. The idea is that if you're doing one period loan, down payment and collateral is the same, whereas if you have appreciation, you don't really have to sell the asset. You can change your equity position by leveraging on the financial asset. And those are going to be important things because you can eliminate refinancing, which has an impact on collateral constraints, but it does not have an effect on down payment constraint. And by making long-term contracts, you can make that clear distinction and separate these two effects that otherwise you could not. The other important thing, which is going to provide some degree of insurance, is going to be being able to default on the loan. And it is something that is going to be pricing by these lenders. We're going to distinguish fixed versus adjustable, and what the lenders are going to do when they originate the loan are going to essentially price the loan, taking two things into consideration. One is the prepayment risk, knowing that this loan may mature way faster than the original termination, and the other one is going to be pricing to the yield curve. The current rate is not what determines the pricing, but also the future path of interest rate. It's what lenders are really pricing in. Whereas with adjustable rates, they take the current rate because they know that they can adjust it at every period. So I think those are going to be key things. And we'll play a little bit with the maturity, and we'll reduce the maturity to show what happens when you have much shorter maturity. What we're going to formalize here is that when people default, the banks repossess the property. We're not going to do anything with respect to, foreclosure management other than having those guys eventually decide when they want to put this property back in the market. We're not going to spend a lot of time talking about recourse, non-recourse. This is a very interesting topic. There's great papers out there, but essentially the focus is going to be on the origination aspect of the loan, not so much on features exposed. And as I mentioned earlier, we're going to have trading friction. So this is going to be an approach in which we're going to have directed search. So when individuals try to sell a house, they have to decide how much they want to ask for the house and in which market they're going to put how much. And that's going to give them a trade-off. If you try to ask for a high price, there may be less shoppers going to that some market. So part of the clearing is going to come from delays. If you want to sell it quick, then you charge a lower price, and we're going to have a distribution of prices. This is just a formality of the timing about buying, selling, defaulting, and then deciding to buy again and making timing decisions. This is just defining superiors. Let me just skip that. I want to emphasize a couple of quick things, and I mainly want to focus not so much on the value function themselves, but a little bit of the budget constraints to kind of give you a little bit of the flavor of the problem. And I want to emphasize two things. When people talk about credit, and there's a lot of papers out there, they don't really formalize long-term loans. So everybody is really adjusting their housing portfolio at every period, especially if they don't have adjustment costs. Not so much in the audience. I mean, Wenli has some papers where you have adjustment costs, so you're not trailing houses every period, but in a lot of models out there, you can really buy and sell. So the relevant constraint is always the loan to value constraint. A point that we want to make here is that changes in credit conditions also affect refinancing opportunities for existing owners. And those are the majority of the holders of mortgage debt. So the margin that is relevant, it's not the extensive margin about who transitions from renting to owning, because an argument is there's a small number of transitions every period. This cannot be the marginal guy driving the price. But most of the action, as we will argue, has to come from the fact that there's some people already in the market and they may move from a small house to a bigger house. And those are benefiting from the wealth effect from the housing appreciation and potentially looser credit conditions. And those are the ones that are putting more upward pressure in prices. So we're going to have those marginal buyers, but a key component is credit conditions affecting the bulk of the existing owners that may want to adjust their portfolio of housing and their finances to the new credit condition. And that's important. So the first kind of Bellman equation is somebody that potentially refinances the new loan, which we call M, to, let's just say, a new lower rate relative to a baseline rate. So this individual doesn't really adjust the housing quantity, is going to keep the same quantity. So everything is going to be a refinancing. So if you look at the budget constraint, let me ignore the value function because it's the utility out of consumption and housing. And here I kind of cheat in the notation. H is already the housing service that you get from the stock. The key thing is these individuals buy the service goods. They service the maintenance of the property. This is the liquid asset that they can adjust at every period from these financial institutions. This is them kind of paying off the old loan. This is the cash at hand, and this is what they get out of the new loan. So with the new loan, they pay off the existing loan, and then they have a balance because they're not selling the house. And the two important conditions that I'm talking about here is essentially on the new loan, they have an LTV constraint that depends on the value of the house, and then determines the size of the loan in the left-hand side. And the other one is the payment to income constraint that essentially what lenders are using is that you can borrow a certain component of your persistent component of income, not on a transitory component. So lenders understand that these transitory shocks are not going to stay around. So they look at the persistent component. Are you high income, middle income, kind of lower income, if you want to think that way? And they want to make sure that the cost of servicing that debt does not exceed a certain percentage. And that's a parameter that we can certainly calibrate. So the point here is that credit conditions are going to affect a lot of people already in the market. And then what we have is other people that are not refinancing. What they do is they pay off the mortgage. So the mortgage today at the start of the period is going to be bigger than the one at the end of the period, because what they do is they need to service interest payments on the debt. And that's what we have here. And then they amortize a component. And that's how the debt diminishes over time. Since I'm running out of time, let me not give you a lot of details about the frictions in the selling market, but this is a directed search on both sides. The buyers are looking for a market, the sellers are looking for a market, and it's a complicated model because we cannot easily characterize this thing because the buying and selling behavior depends on the whole, vector of state variables, your current income, your current wealth, so the willingness to pay changes. But the key component here is if you wanted to sell the house, you cannot sell the house, you cannot put a value for less than what you owe the bank. So if you owe the bank 100 and you're trying to sell the house, the minimum that you can put in the market is that amount. Then you, without defaulting, you can default and then you kind of hand it out. But if you're trying to sell it, you cannot try to sell it for less. That's a key thing.
So just a quick question. So you have one market per, per size of the house. And then
so we don't. Yeah, I was not very clear about that. in this current formulation, the market is for the quantity of house, so we don't have segmentation on small, bigger, and larger houses. All of those are sold in the same market. We're really looking into segmentation, but that requires to basically clear as many markets as house sizes. And this is an important dimension, and we're currently exploring that. But for today, we're going to assume that what they're selling is a homogeneous good, and there's no different price for different. The price per square feet is the same for every single market.
Okay, I see. Thanks.
This has some implications because basically we're imposing a constraint on how much you can sell. And the only thing that I want to show is when you look at leverage for those individuals that have poor assets, when you have low leverage, the listing price is essentially unchanged. But when you look at individual that is asset poor and is in distress, he's trying to basically sell quick by putting the house in the market for a lower price, but up to a limit. And then at that point, if they're more leverage, that constraint that determines the leverage constraint is the one that really pins down how much they can ask for. So essentially, they would like to reduce the price, but at some point, the bank says, you know, cannot sell the house for less than what it's worth. You give it to me. And that point, that really changes the behavior on how much are they willing to sell. And that generates, you know, all kinds of interesting dynamics. But given the limited time, this is a complicated equation, and all it's really saying is those guys that are pricing the loan are taking into account not only current rate, but future rates, default probability, the cost of selling a house that has been repossessed, and a whole bunch of shenanigans. So it's a really complicated object that tries to take into account all the continuation nodes for the lenders in case, you know, you service the debt at every period or you end up defaulting. Complicated model, large, hopefully at least at a high level, it was not too obscure. We try to match it to the data. There's some parameters that I would argue they're fairly standard. A key component is the elasticity of situation between housing and consumption is less than Cobb-Douglas. So in the extreme case, you would have Leontiev, in which consumption and housing move 1-for-1. We're not quite there, but you know, I think the one we're using here is like 0.5. So these are things that we kind of pick off the shelf. And then these are some of the parameters that we try to match from the data, and the number of homeowners, the starter house value. Axel was asking me about housing wealth. We try to match some feature of the SCF. There's no capital, but the liquid bond is trying to proxy for that. This is going to be a quarterly model because it is a market in which liquidity is important. So the notion of a period here is a quarter. It's not going to be 1 year. So essentially, when you look at if you were going to sell the inventory at a given point, that's about, you know, almost 6 months in the US. So we try to capture how long does it take to sell on average and the number of weeks and dispersion between the maximum bid and the maximum discount. And then we also look at default rates, which in the US in normal times are pretty low. They're kind of 1.6. And then a key important component here is going to be the distribution of the LTV ratio in the cross-section. And these are things that we're going to try to calibrate. I think I'm over time, right?
So you have like 3-4 minutes.
Okay, so let me just fly through the things. So we try to capture basically distribution of LTV, new borrowers have more loans. What we're going to generate here is a boom that has several features. There's going to be some real variables to generate the boom, some income increase. Then we're going to talk about income risk. That's going to be normal. And then we're going to increase the amount of risk. So that's going to generate some uncertainty. And then in order to make some adjustments on the financial side, we're going to basically generate a decrease in the interest rate and then a tightening of borrowing costs. So we're going to differentiate 4 different episodes: a baseline, a boom, a bust, and then a recovery period that tries to mimic what happened in the US. So this is just one way to approximate in a very stylized linear way something that we identify in the data in terms of income risk, which is an important driver of defaults, interest rates kind of going up and then kind of going down, and then the real value of mortgage rates. Try to capture something that look like the data, okay? So fairly quick, When you have that, we're going to separate basically the boom period in which you cut interest rates, you increase income, and you try to see what happens. And that generates a housing boom that essentially increases prices on impact at a surprise about 40%. In the short run, the supply is more or less fixed. You start producing more houses, and then kind of prices settle about 30%. There's going to be another shock unexpectedly. So there's going to be kind of 4 MIT shocks that come, one after another. What happens is when the boom happens, housing is very, very liquid. When bad news arrive, housing becomes, very, very liquid, and properties stay on the market quite a bit. During that period, foreclosures are spike. Initially, there's an increase in homeownership rate, not so much when prices go up, but as you produce more and more people come to the housing market.
So the bust is not endogenous to the boom.
The bust is not endogenous. That's kind of the trifecta. If somebody could generate an endogenous bust, everybody generates bust out of MIT shock. An alternative formulation would be one in which you have an exogenous probability function that depends on the aggregate number of leverage. Gilles has a paper of that. You postulate an aggregate function, and when you exceed a threshold, you generate a bust with some probability. And the last couple of things are leverage. And then what we look at down there, it's, I think model versus data in terms of the magnitudes. And we would argue that for such a stylized model, trying to capture aggregates is fairly good. Some
Can I
differences
just ask, like along the boom and the bust, like the dispersion in prices is changing? Is it?
Yeah, during the boom, there's a lot of compression, and during the bust, you have a lot of dispersion. And I think I may have a picture somewhere in there, but that really changes, and that's reflective on the time on the market.
That's in line with the data. I mean, just to get a sense of the magnitude, that resembles what you see in the data, really.
That's in the data. We have not done a lot of work we're doing more of that, especially in the bust about price cuts. But yeah, that dispersion is in the data. Here we have this composition, but let me talk about there's some asymmetries on the balance sheet, but since I'm running out of time, we talk about the liquidity. This is matching it with the data to what extent month supply deteriorated. But let me talk about the mortgage features. There's some evidence that we can look to what extent housing liquidity was important. So we kind of run some Mia and Sufi type of regressions, and we get the same coefficient, and we expand those regressions about housing liquidity using our measures, and we find that increases the predictive power of some of these regressions, because time in the market is an important thing. But let me go back to what I started here. Housing finance, how is that important? In the last couple of minutes, let me talk about what happens when you eliminate the option of extract equity, and this is going to have impact not only on current owners, because they eliminate the possibility, but future owners take into account that if there's appreciation, they cannot extract equity. So eliminating that feature reduces the housing boom by 40%. So it has a huge impact. So the fact that you can buy an asset and you can extract equity has a huge impact on the pricing. Who is willing to pay more for that in the pricing when you look at these, individuals that have, high LTV? Because those are the ones that they may need to extract equity, not the super wealthy guys. So liquidity is going to be a key important component. Those that have a lot of, financial wealth are willing to pay less for that feature. And I think that's an important component, because their consumption is substantially less sensitive than those that can actually use that as an equity. Couple of final ideas. One is about the mortgage structure. What happens if you have an exposure to interest rate? Do the macro variables change when you have adjustable rate mortgages? Now you're exposing household not only to interest rate risk in addition to house price risk, and that translates into housing variables as well as macro variables. So when you have a period in which interest rates go up because credit gets tighter, the amount of foreclosures increase dramatically more. It's by a factor of 2 more. And then that also translates into consumption. A lot of individuals default to avoid to have to cut their consumption too much. But those that do not default, they have to cut the consumption more, because now the debt servicing cost is substantially larger. So the bottom line is interest rate sensitivity in periods in which prices are falling and interest rate or cost of borrowing are kind of going up makes the response of the macroeconomic variables, increase. And this is an important component, because right now we have high inflation, high interest rate, There's pass-through on people that are interest rate sensitive in a situation or a junction in which house prices can collapse. And that has an impact, at least from the perspective of a policymaker. That has some cross-section implications that really affect the poor households. The final one is what happens if we reduce the duration of the mortgages? The standard feature uses 1 period, and what you really expose here is individuals to rollover risk. And you see that in the dynamics of homeownership rate. When you have a credit tightening, there's a massive exodus from owning to renting relative to the fixed rate mortgage that has more smooth dynamics. Here, we don't have any feedback from rents going up, pushing those guys again to the homeowner market. So the rental market should absorb a lot of people, a big cut and an absorption, a big drop in consumption. And that has implications for outstanding debt. Big implications in the cross-section. The final thing that I want to finish in the last 30 seconds is, what can macroprudential do? Well, two things that we could potentially do. One is put LTV caps, and the other one is put payment to income constraint caps, making those things tighter. Those have big implications on the appreciation of housing, and I'm just going to focus on that, right? But there's also an extensive margin implication. Putting constraints on the supply of credit limits how much prices can increase, but because house prices don't increase as much relative to the baseline, housing is more affordable and more people get into the housing market. So they don't pay as much, but more people can get into the housing market through the extensive margin. What happens is when the bad shock arrives, what you do see is that the amount of foreclosures increases. Why do they increase? Because we have now more people in the hook for less amount, but there's more people in the hook. And those marginal buyers are the poor households. So those are the ones that, they kind of borrow more. So the important thing is those things have implications on fragility because they bring more people into the owner-occupied housing. So let me just conclude. It was a speedy presentation with a lot of stuff kind of shoving there and a very, mild description of the model, but hopefully a few things got into consideration. Basically, to generate booms in house prices, easing credit condition in conjunction with some mild changes in fundamentals can generate movements in prices that are consistent with the data, both in the real estate front as well as the macro front. The mortgage structure has implications on who gets into housing and how exposed is the economy by affecting the cross-section of credit. And that cross-section of credit, it's an important component because it gives you more information that, mere sufficient statistics than only look at averages, because it really tells you how many guys could be on the hook if there are, worsening conditions in the labor market or increases in the cost of borrowing, if people are exposed to rollover. We've seen that some of the rich features of the housing market really don't affect, who gets to buy, but those exist in the housing market through equity extraction. So those things are important. Something that we're seeing right now, which is obvious when we compare cases between the US and Europe and within Europe about current inflation going up and the ECB tightening. Today, the ECB tightened the credit rate by, 50 basis points, that those things are, having a clear pass-through on existing borrowers, and that's going to affect consumption and investment. And I think that's important. And I think some of the key lessons from this work is that, when we're thinking about macroprudential policies, it's important to think about from a holistic perspective, not just to think about the aggregates, but also to think about the cross-section and what are the implications in equilibrium prices, which in our case are sensible. You change the macroprudential, you change, the intensive margin of who gets into the housing market, and also you affect house prices. I think that's an important margin, even ignoring the fact that I really have shut down the rental market. And sorry I went extra, long, and I took some of Wenli, time.
No, it's really, I'm gonna give 45 minutes to Wenli anyways. But thanks a lot for your presentation. But we are probably not gonna take time for questions now because indeed we are a bit over time. So Wenli, you can start. Thanks.
Can you guys hear me?
Sorry.
Can you guys hear me?
Yes.
Oh, good. Okay. Can you see my slide?
We cannot see your slides.
Yes, it's difficult to hear you. Sorry.
Oh,
Perhaps you have to be.
Yeah, it was better
not too
earlier.
much beside your microphone. Sorry.
Yeah, let me switch to my laptop.
Yeah.
Is this better?
It's good now.
Definitely.
And my screen, you can see, just give me 1 second for this thing to settle down. Yeah, thank you very much to the workshop organizers for including this paper. This is joint work with Kostas Magia and Florian Oswald. The views expressed here are those of mine and do not necessarily represent the views of the Federal Reserve Bank of Philadelphia or the Federal Reserve System. This is a really old project that we've been working on.
We cannot see your slides yet, right?
Oh, you cannot see my slides?
No.
Oh, what am I supposed to do?
Just actually sharing your screen.
Okay, you're right. Can you see it now?
It's loading. And we can see your border.
Yeah, actually, I was just Googling. This is just one quick comment to Carlos. Carlos, I was wondering how your paper differ from Violante's JPE, but we can talk about that later. Is this good now? Yes?
It's perfect. Thanks a lot.
Great, thank you. Yeah, I don't know how to move this box. Right, so just, and this is a old project, but we finally managed to finish to submit. So the sort of general motivation, consumers over the life cycle experience many shocks. The adverse shocks include unemployment, medical expenses, house price crash. And in the US, there are bankruptcy laws and mortgage foreclosure laws that provide some insurance against these adverse economic shocks. And these laws differ by states. And additionally, they affect households very differently depending on their income asset positions. And moreover, credit supply also responds as a result of the existence of these insurance schemes. So the research questions we tried to answer here is how does bankruptcy interact with mortgage default? How do these loan performance decisions affect household savings and labor supply decisions? And most importantly, what are the distributional welfare implications of the various proposed as well as past bankruptcy reforms? So the contribution, this is a large and there's a huge literature during the almost 10-year time we've been working on it. Really, we basically have a more sort of a rich framework with lots of features which we think are important. And some of the features are standard, the presence of housing, consumption, saving, borrowing decisions, labor supply, that's new. Bankruptcy, mortgage default, that's not new anymore. And the ex-ante income heterogeneity that turned out to be really important. And not only in the income process, also in preference, we allow for preference heterogeneity as well. And as I mentioned, there's a large and extensive literature on this topic. And the paper that's most related to this one is the Midman's 2016 AER paper. The differences are really in the details of our analysis. For example, the life cycle model, the labor supply decision, and the ex-ante heterogeneity, as well as the introduction of expense shocks. So these features actually lead to very different welfare implications, results, than that from the Midman, just to highlight one of them. So in our analysis, we show that the complete elimination as well as the BAPCA actually lead to some welfare loss over the general population, but much more so for the lower education people. Just a quick overview, maybe this audience doesn't need that, but let me just kind of quickly run through the US consumer bankruptcy regulations as well as foreclosure laws in the country. There are 2 chapters in terms of personal bankruptcy. Chapter 7, that's the fresh start. The cost, you get your debt discharged, but you have to sacrifice some of your assets up to a level or beyond certain levels. That's the homestead exemption level. And if you file under Chapter 13, then you have to do an income payment plan. And filers are prevented from filing again for 5 to 6 years. And the mortgage default foreclosure, that's much more like state, driven by state level regulations. There's judicial versus non-judicial. Judicial takes longer. There's recourse versus non-recourse. Recourse means you can go out as a mortgage lender, you can go after borrowers' other financial assets. The BAPCA 2005, that's a very creditor-friendly law, which basically made bankruptcy filings more expensive, and particularly Chapter 7 bankruptcy filings. And for the filers to be eligible, they have to, excuse me, to pass the earnings test, meaning that their income has to be below state median income. And there are also other provisions which basically made bankruptcy a much more expensive option for borrowers. And just to give you a sense of, the time period that the past 20, 30 years of the aggregate trends in personal bankruptcy filings as well as mortgage defaults. The red vertical line indicates the passage of the BAPCA in October 2005. So the bankruptcy laws, it's been going up. That's what led to the passage, the discussion and eventual passage of.
Only I think you're frozen.
Yes, I think we have a
we lost.
problem with Wenli.
She's using a Fed computer, and that's what happens when the BN disconnects. So I guess we
Right.
lost her.
I guess, yeah, she's gonna have to reconnect completely.
I use my private computer to avoid these issues.
Will she realize that she's disconnected, or should we message her?
Well, she should be able to see the screen.
Oh, I see.
I'm still gonna email her, but
I think she knows that she got disconnected.
but yeah, probably she knows now. And she should be able to connect soon, no? Or does she have to restart completely the computer? Or?
She shouldn't, unless there's something a bit larger in the Philly Fed, or from, she's connecting.
Right. Well, let's wait for a couple of minutes and see.
We were not allowed to use Zoom.
She's back.
She's back.
Hi.
Can you hear me now? Yeah, sorry. We are having big rain. The connection was knocked off. Can you see my slides now?
No, you have to reshare. Sorry.
Okay, let me share again. Can you see it now?
No.
No. Okay. Let me click on it.
It's coming.
Okay, great.
Yeah.
Also, could you pin the video of Wenli? I think for the recording should be useful.
Video only, right?
Can you? But you can see my screen now, right?
Yes. Nice.
Okay, great. Yeah.
I know.
Okay, you can see the screen. You can hear me, right?
Right. Just your yeah.
Okay.
Thanks.
Okay, wonderful. Yeah, apologies. There's big rain going outside. Maybe I'll just skip the time trend. Essentially, we had bankruptcies, the Chapter 7 in particular going up and then coming down, and then the mortgage defaults. We basically had a great recession in the middle. And then here in this chart, I'm doing the county level regression analysis, which is to establish the close relationship between bankruptcy filings and mortgage default and how they relate to the various laws governing these two processes. And nothing's too surprising. These two events are closely related. However, some of the laws that are governing the foreclosure process are important, but sometimes they are not. And that's mainly due to the lender's reaction. Well, that's a speculation right here. It's just not speculation. That's one of the reasons is because of lenders responding to the existence of these laws. There's been a lot of empirical literature on that. by charging higher rates and etc. And also, since we're going to introduce ex-ante heterogeneity, I just want to put it out there that using PSID data, looking at the high versus low education people, we already see that the high educated people work more hours. They tend to have more home ownership, and the age is about the same. And this is going to be important when we, later talk about how changes, different reforms would affect these people differently. I'm going to give you some, so the models are very similar in many ways to what Carlos have shown. So we don't have that complicated dimension in terms of the pricing. It's essentially kind of like a household decision model, but we have a lot more complications in terms of the kind of decisions the household has to make. So it's a life cycle model with two assets, different set of discrete choices for renters and owners, and interest on unsecured debt as well as mortgages are both endogenized. And the exogenous wage process vary by age, by education, I'm sorry, and then we also allow for house price shocks as well as this expenditure shock, which is essentially something that just happens, takes away from your budget. It's almost like an income shock, but it's RID. In terms of model, this is something very familiar to you by now. So we do allow labor decisions. So there's a labor market participation cost, fixed cost. And this is the, I don't know if you can see so the housing utility, enters multiplicatively, but also additively. So this latter term is just to capture this sort of warm glow of ownership utility, a trick for most of us use in different forms to capture the extent of home ownership in the economy. And just to go over the shocks, as they're kind of important in this model, the house price shocks are very much, it's exactly the same as that's in the Midman model. We don't model any aggregate shocks. An individual's house purchase price is normalized at 1 at the time of purchase, then it varies idiosyncratically. So this is important, it's idiosyncratic house price shock. For wages, however, we allow it to vary with age as well as education level. The catastrophic spending shocks follows exactly in the AER paper by Lifshitz et al. And it's RID, and it's idiosyncratic as well. So for unsecured debt, the lenders know bankruptcy is an option, so they take into account and price each individual loan. So basically, we assume free entry and hence zero expected profit on each loan. And mortgage lenders make the same decision. And here we model the mortgage side very carefully, in the sense that we explicitly model the length of the mortgage contract. In the literature, people have used, for example, in the Midman paper, other tricks such as there's a probability of your loan becoming, like this kind of stochastic way to sort of capture. I think it's first proposed in the Chatterjee and Bougie-Egungar paper to capture kind of mortgage length. And here we don't model ARM, but we model very explicitly what we see in real life to fixed rate mortgages. So obviously this is going to be complicated. This is if you look at the pricing kernel of unsecured debt. On the left-hand side, we have how much you have to sort of, or the discount you get for taking out the A prime loans, and it's going to depend on if you don't default, which is the first term in the square bracket. And that's, you pay the whole thing. There's a negative sign because if you borrow, A prime is negative. And if you file under Chapter 7, it's going to be, so it's going to be sort of a proportion of your home equity that's not exempt from the bankruptcy laws. And then the last term is the expected income coming out of the payment plan. So this is how the interest rate on unsecured loans is determined. The mortgage rate is determined similarly, in the sense that you have a fixed rate mortgage. And if you default, the house will be foreclosed and the house would be sold at a discount. And if You don't default, then the lender gets the per period payment, and the mortgage will be priced accordingly. All right. So when a consumer enter into the bankruptcy punishment state upon filing for bankruptcy, they're going to be excluded from credit market that period. They cannot borrow a new mortgage, and they suffer from a non-monetary utility loss as well. And also, they will be, if they file, they will be in this punishment state for, on average, TBK periods. And here we're going to use that trick, which is, you're going to exit with a probability delta each period. But on average, the punishment length will last TBK time periods. And if you're not in the punishment state, then they have the option to file every period. Filing also means at that particular period, basically your assets is zero because your debt is discharged. And the future values, right, so if you file, all your debt are discharged and there's no assets left, basically your asset position is zero. And then there's, future value comes from the going forward next period, you'll be for sure in the punishment state. And if you default on your mortgage, your mortgages will be excluded, it will be erased, but you cannot buy right away. And then also there's a possibility that there's going to be a deficiency judgment, meaning that your other assets may be taken away by the mortgage lenders as well. So we're going to model that also as a probabilistic event. So I'm not going to show you how much time do I have, Axel?
So you have 25 minutes?
Oh, okay. I do have some time. Wonderful, thank you. All right. So I'm not going to show you like each value function in too many details, but just kind of list out the decisions they have to make. So for agents or households in non-punishment state, for renters, the decisions they can make is, whether they continue to rent, whether they buy their own residence, and we abstract away from investing in the housing market as an investor. They can also decide whether to file for Chapter 7 or to file for bankruptcy under Chapter 13. And of course, they will only do that if they borrow. And if they are owners, they make the following decisions. There's also labor supply in borrowing and saving. So they can decide whether to stay in their house, whether to sell, whether to default on their mortgages, whether to file under various bankruptcy or to combine bankruptcy filing as well as default decisions. And if they're in the punishment state, then some of the decisions are no longer available to them. For instance, if a renter is in a punishment state, he cannot buy, and obviously he cannot file again while he's in that state. And similarly for owners, while in the bankruptcy punishment state, they cannot buy nor file for bankruptcy. Note that we do not, so what we abstract away is, if you have defaulted on your mortgages, in practice, there's something called credit score that's going to affect your borrowing ability. And here we abstract away from that consideration. So there's no longer term punishment when you default beyond in that particular period. You're going to lose your house. You're going to lose your house, and you may also lose some of your financial assets. Okay, in terms of so that we're going to use the following data sets for estimation, and so the strategy is really to match a series of aggregate moments by age and by education for the period prior to the Great Recession. The wage ownership rate and hours worked profiles come from PSID, and there's a large literature on how one can go about estimating, the earnings process or the wage process. So we basically follow those strategies, in particular the Donardi and co-authors papers. And our numbers are—
Can I ask you a question on the estimation? So
yes.
What you want is too much heterogeneity in hours worked for different type of people?
Yeah.
And I mean, are you also interested in like what is the typical response of hours worked after going for bankruptcy, for instance? Can you see that in the data? Like, can you show us?
Actually, yeah, that's one weakness of the data. So there's really no data out there except the PSID, many years ago asked a question. I myself did an empirical paper on that, where we did not find very strong response. And I think one can rationalize why that's not the case, but there's also a weakness in the data because it's just not, it's like a kind of asking in the past, have you ever filed for bankruptcy? So we don't have, yeah, but I think Dobie might have something, but I think William Dobie and Jason might have used Social Security data, but I believe they only have income there.
Right.
So we don't have very good hours data.
I see.
Associated with bankruptcy filing. And and honestly, we also don't have great data on bankruptcy filing by education either. So in our calibration, we basically kind of classified counties based on the fraction of the county residents who have a college degree, and then take the bottom 25%, take the counties that have less than 25% of their population that say they have college degrees as low education people, kind of think them as a low education people, and the top 25 percentile as the college graduates. So these are the two, that's the approximation we did for this analysis.
I see. All right, thanks.
Yeah, okay, so the aggregate bankruptcy filing rates come from the American Bankruptcy Institute. The default rates, we take it from the New York Fed CCP data, and the legal environment, those are fairly established, and we take from the literature. So it's a complicated model with a lot of parameters, but luckily there's a large literature on this topic already. So a lot of these parameters we can really take from the literature. So I'm not going to go to details of discussing these parameters. Some of the other parameters we estimate trying to match selected moments that we see in the data. I just want to point out that we do allow preference differences among people with high education versus people without college education, and that's And yes, you can see that they do differ in terms of fixed cost of work, bequest weight not so much, and the housing warm glow. So this is important to keep this in mind, because when I show the welfare analysis, also differences in their decisions, it's driven not just by their the stochastic income process, the different income process they face, but also by these sort of different preference parameters we identify from the data. All right. So this is just this is a bit overwhelming. Maybe I'll just pick the top two charts to discuss. This is the decision rules, and the top left is we charted an owner, a 26-year owner with a 1-year-old mortgage, and his decision. So the x-axis is hourly wage, and the y-axis is the amount of unsecured debt. So you can see that on the top right, if they have a lot of, if he has a high wage and not that much unsecured debt, then he would stay in his house, right? He would not sell. But if his unsecured debt becomes more, then he would choose to sell his house. So this is in the absence of any house price shock. And interestingly, when his wage gets a bit low, but his debt gets a lot, then, well, not interesting as you would expect, then he would choose to file for Chapter 7 to have the debt discharged. And since he has little home equity in the house, and he doesn't feel the need to protect his housing assets, home equity either. And moving on to the top right panel, here we're looking at a 26-year-old homeowner, but who had a adverse house price shock. So in this case, he has, when his wage is high, but even though his, unsecured debt is not that much, but because of house price shock, there's that large region he would choose to default on his mortgages because the equity is wiped out and it no longer pays for him to stay in the house. And then depending on his wage profiles, if he has a lot of wage, then because the payment plan is proportional to the income, then he would not want to file under Chapter 13 because he would pay more. And he would choose to file under Chapter 7 to have his debt discharged, unsecured debt discharged, but to protect his labor income. And then when his labor income is somewhat low, then he would move first into Chapter 13 and then into Chapter 7. Okay, so that's how, with all this additional layers of heterogeneity and price shocks, and you see how these decision regions vary with these shocks as well as their income and asset positions.
Wenli, to ask a question here, and does the home equity play a role in the decision?
It does. That's why I was trying to show you. Look on the left, right? That's a owner who didn't face the adverse house price shock. You see that he doesn't default on his mortgages, right? And he chooses to file for Chapter 7. There's no, 7, 13. But if you move to this top right, because he's lost his home equity, then he's going to default, much more likely. And you see the bankruptcy region also look different from the top left.
And what are the trade-offs between Chapter 7 and 13?
So under Chapter 7, that's the so-called fresh start. And basically you have your unsecured debt completely wiped out. So as you can see, if you have a lot more unsecured debt, you're more likely to file under Chapter 7. So this is going down the vertical line. But if you have any home equity in the house, or if you have any, well, obviously you have debt, you won't have liquid assets in this case, in the model, then you may also lose your home equity. You will also lose your home equity beyond the home exemption part.
I see.
Under Chapter 13, so what you do is what happens is there's a repayment plan. So you pay proportionally relative to your wages. So when your wage is really high, you actually would not like that. But then the upside is that you get to, if you want to keep your house, you get to protect it. You get to protect your assets. So that's the trade-off. In Europe, I think it's more Chapter 13, if I remember correctly, that you have more of a Chapter 13. You don't have this sharp distinction between Chapter 7, Chapter 13, and your bankruptcy is more like Chapter 13. You have to pay out of your future income.
Yes, thank you.
Yeah, so these are the trade-offs. And I didn't show expenditure shock, but if expenditure shock hits, and that's super important for that's one of the things. It's not, a lot of these decisions are endogenous, right? For example, how do you get into this unsecured debt situation? That's really because you borrowed in the past, because you had a bad income shock. You either borrowed, you borrowed a lot, but then this expenditure shock, they turn out to be important for some of the welfare analysis, because that's not something, other than you try to save to provide yourself a cushion. It's not something you could do to reduce the exposure. This is the model fit. Let me skip that. We did some elasticity thing. This table is a little hard to explain, so let me skip that as well, but focus on. So I think the earlier question, is it Axel, you asked about the labor supply decisions upon near bankruptcy filing. So this is a chart. This is again from the model, not the data. We're trying to see how filers. So here we're looking at filers. 0 is the at the point that someone filed for bankruptcy. And then we tried, so the top 2 panels shows the person's income and asset positions, and the bottom 2 shows their labor effort. So if you look at the top left, the orange line shows that this is a fraction of people. So this goes by the left y-axis. So most people got into this situation of bankruptcy filing because they've had income shock. So that's like 80% of these people have had bad income shock. And some people got good income shock, but how did they still end up in this situation? And this could be they got a really bad expenditure shock or price shock. Okay, but most of them was due to income shock. And this solid line, black line, not solid, this dotted black line is their labor income. So because of the shock, the labor income took a hit and then recover only very slowly post the bankruptcy filing. And if you look at moving to the top right panel on this green line, yeah, we should have chosen a different color. It's the same as the this dotted black line on the left panel. This is the labor income. It's a different scale, so they may look different, but they're the same thing. And you see here the asset position also dropped. This is because the households are basically running down their assets or borrowing more, leading to the bankruptcy filing. Or it could also be because they had a bad expenditure shock, they had a price or house price shock. But amazingly, look at consumption, right? Even though they've had all these shocks, because of the availability of bankruptcy filing, the consumption are fairly stable. And turning to labor supply decisions and these two charts, and hopefully it's going to convince you that it is actually important to model those dimensions, even though they complicate our models and computations substantially. So look at these Chapter 7 filers, right? So leading to the bankruptcy filing, which is year 0, they actually work more hours. So they try to, they basically try to avoid filing for bankruptcy, but at some point they just couldn't do it anymore. The debt becomes too much, and that's when so as soon as they file for bankruptcy, because of the really low wage. So here the labor income shock, we take it as a wage shock. So they greatly reduce their working hours. So as their wages recover, they gradually recover, begin to work more hours. And if you look at, I think this is consistent with the labor earnings that's documented in Dobie and co-authors' papers. And if you look at the asset position, look at a Chapter 13 filers, it's less obvious, but you do see a slight increase in labor hours leading to the bankruptcy filing as well. And again, because of the wage shock, they're going to work much fewer hours upon filing for bankruptcy, but then gradually recover. And the recover process is long. And this is because, the wage shocks are persistent.
And can I ask, do you have the decomposition extensive, intensive margin?
Oh, we could do that, but we did not.
That would be nice to see.
Yeah, I off the top of my head, I did not have that.
Thanks.
But we certainly, the model has that feature because of the fixed cost. Yeah. Okay. So I think by now you probably get a good sense what's going to happen with the various kind of, the bankruptcy reforms, right? Here I'm doing the hypothetical one. So as you can kind of get an idea already, it's really the sort of the lower income people are more likely to file for Chapter 7, right? But then some of the high educated people would also try to file for Chapter 7 because once their income is too high, then more of their wage income, they have to prepay out of their wage income more. So here we did, baseline is the one that's the US economy before the Great Recession, before the passage of the BAPCA Act. So when we completely eliminate Chapter 7, it's actually a good thing for the high educated people, because it lowers the interest rate is going to be lower. They're able to, because they file for Chapter 7 much less to begin with. But for them, they actually benefit more from the Chapter 13 filing. Remember earlier I showed you statistics, these people are more likely to have all sorts of assets, particularly the housing assets. They're more likely to be homeowners. So when you get rid of Chapter 13, they suffer more. And if you look at the low educated people, it's the other way around. So when you look at the aggregate statistics, you would say, indeed, we get the similar results that even though on average that the society is slightly worse off, but then it's very small number. But if you look at people by ex-ante heterogeneity, then you see these huge differences in the, in these different reforms. And this is, if anything, one important takeaway I wish you can get from this paper, which is this ex-ante heterogeneity are very important for these kind of discussions. And if we only look at, if we only have ex-post heterogeneity, then we're not going to get these kind of distributional effects of these reforms that have been, greatly discussed.
I just missed something to interpret these numbers. This is taking into account transition, or is comparing steady states?
This is only comparing steady states at some point. So this is, so despite my earlier comparison to, Mittman's paper saying that we have a more realistic model, life cycle, mortgage contracts, labor supply, and so on and so forth, we do suffer from a significant shortcoming relative to his, which is he studied transition dynamics. In our model, it just gets way too complicated to do that. So we only did steady states. Yeah. So I should have pointed that out earlier. And as you can imagine, BAPCA essentially made bankruptcy filing a lot harder. And it also made, it's trying to push people into Chapter 13 filing, making Chapter 7 a lot more expensive. So not surprisingly, this is just a sort of a subdued version of these previous policy experiment I showed you in the previous slide. So not surprisingly, the high educated people is actually going to be slightly worse off as well. This is because of a lot of that coming from the expenditure shock. So expenditure shock is really important for welfare discussion of, of these reforms of the bankruptcy laws and mortgage foreclosures. And then the low educated people are much worse off for the same reasons that I discussed earlier.
The exception limits, they counteract the effect of the 2005 law.
Say it again. I'm sorry.
So there were some increases in the limits, right, for Chapter 7.
Increases in the what limit?
In the homestead limit.
Right. I believe we included that. See, for the low educated people, they, much fewer of them own homes. So they don't benefit from that as much as the high educated people. Right. Yeah. So I believe we have that, but I think it's really the cost and also the means testing that hit these people the most. And again, the big and if I aggregate over this too, the effect is bigger than the high educated, but it's much smaller than the the negative 0.6 we see here. But again, I want to emphasize this heterogeneity, of the reform ex-ante different population.
Yes, makes sense.
Okay. All right, just to conclude, we think the labor supply, let me just kind of run through, re-summarize the three takeaways from this paper. One is, we think the labor supply is important because we clearly see in the model and as well as in labor income from the literature that labor supply adjusts before bankruptcy filing. So it's not all, people try to sort of take advantage of the system. They try to work hard to mitigate the effects of negative shocks and to avoid filing. And so it is important in that sense. And also we want to emphasize that availability of Chapter 7 benefits the low education group, while the availability of Chapter 13 benefits the high education people. And these come from their different income processes, as well as differences in their preferences for housing and for labor participation. And also because of these additional margins, we show that in contrast to earlier findings, and I myself is guilty of that as well in my paper with Pierre Sartre, that the overall wealth effects in BAPCA is actually negative, especially for low income group. Yeah, that concludes my talk, and thank you all very much, and also wishing French soccer team all the best in the finals.
Thanks a lot. Tough topic. No, thanks a lot for your very interesting presentation. If there were one more question, we could spend 1 more minute. I don't know if someone has last question, and otherwise we'll stop there. Thanks a lot for all the presenters. I was very interested in the 4 presentations. And I hope to see you in person soon, all of you. And that's it. Thank you.
Thank you.
Thank you very much, everybody. We got a nice message from Philippe Trainard from SCORE, so everything is fine.
You did a good job.
Yes, I hope so.
No, thanks a
Thank you
lot.
very much, and good luck Sunday.
Thank you.
Okay.
Stressful
Bye.
time.
Thanks for
Bye,
organizing.
Carlos. Bye, Sonia. Bye, everyone.
Bye.